So let's go ahead with the next RTP, that is RTP May 2025. Now the very first question over here is on total income question. The assessee is a domestic company. The profit of the assessee is how much? The profit of the assessee is 1 crore 7 lakh rupees. Now I have already told you that whenever a question on total income comes, you need to always see the last line what they are exactly asking. So they are asking us to compute the total income and tax liability as per 115BAA. So as per 115BAA, you are supposed to compute the total income as well as the tax liability. So let's start computing the total income and tax liability as per 115BAA. The profit is 1 crore 7 lakh. The very first thing which is given over here is the credit to the PNL, and then they have given the debit to the PNL. Let's talk about the credit to the PNL first. The first item which is credited to the PNL is rent received from vacant land. Always remember, when you receive any rent from a vacant land, that goes under IFOS. It is not income from house property. If you want to classify an income as an income from house property, there has to be a building or land upper tenant to the building. A vacant land will go under income from other source. Therefore, reduce from here and show under what? Show under income from other source. I hope it is clear to all of you. Second one, you are earning some rent from commercial property of 5,30,000. The tenant has deducted 10% TDS. Okay. So now this rent will go under income from house property because this is from building. This is from a commercial property. You will reduce this rent from here and you will show this rent under income from house property. From that you will claim 30% standard deduction. Now the question will come to some of your mind that whether we get deduction of 30% standard deduction in 115BAA. The answer is yes. In 115BAA, 30% standard deduction is allowed. In 115BAB, it is not allowed. In 115BAB, the rent is directly taxable. But in 115BAA, you get the deduction of standard deduction and municipal tax also. I hope it is clear to all of you. Next one, you have got some income tax refund. On that, there is some interest. So what is the treatment of interest on income tax refund? It goes under income from other source. Reduce from here and show under income from other source. Next one, you have sold some plot of land for, and the profit on the sale of land is 8 lakh rupees. So first of all, do one thing, reduce this profit from what? PGBP, and show this profit under capital gain. So how to compute this profit? So for that purpose, they have given some information in the point number 6 in the additional information. You can check it over here. The plot was purchased in Jan 24 and it is sold in March 26. The plot was purchased for 50 lakhs and it is sold for 58 lakhs. Therefore, the capital gains will be considered to be long-term capital gains. So how it will be considered? Long-term, because it is sold for after 24 months. Therefore, this 8 lakh rupees will be long-term capital gains. So what is the ultimate treatment? Reduce from PGBP, show under capital gains. Under capital gains, you have to show 12.5% as your tax. I hope it is clear to all of you. Next, you are receiving some dividend from foreign company of 6 lakh rupees. So the very first thing you will do is reduce from PGBP, show under IFOS. But at the same time, to invest in this foreign company, you have taken a loan. Check here in point number 8. You have taken a loan. On that loan, you have incurred an interest of 1,50,000 rupees. So do remember that against the dividend income, do you get any deduction? Yes. Against dividend income under IFOS, we get only one deduction, that is interest expense. That to up to 20% of the dividend. Now, what is the treatment? You are paying 1,50,000 as interest. Okay, but your dividend is only how much? 6 lakh rupees. What is 20% of 6 lakhs? You will get only 20% of 6 lakh as deduction from IFOS. That is 1,20,000 rupees you can claim. So what is the treatment? Add back 1,50,000 in PGBP and in IFOS claim 1,20,000 as deduction, because only 20% will be allowed as deduction. Again, I am saying this 1,50,000 add back in PGBP and claim 1,20,000 as deduction under IFOS from 6 lakh rupees. Therefore, your net dividend will be how much? The net dividend will be 4.8 lakh rupees. I hope it is clear to all of you. That is ATG, but ATG is not allowed in 115BAA. Therefore, add back this ATG deduction also. Next is you are contributing some pension for your employees. Now, if an employer contributes pension for employees, is the employer eligible for deduction? The answer is yes. How much? 14% of basic salary plus DA in terms. 14% of basic salary plus dearness allowance in terms. Now, what is the basic salary in dearness allowance in terms? That is given in point number 7 below. It is 10 lakh rupees. The basic salary and dearness allowance is 10 lakh. Therefore, 14% of that is how much? 1,40,000 will be allowed as deduction. But you are contributing how much? You are contributing 1,90,000. Therefore, how much deduction will be allowed to you? Only 1,40,000 will be allowed to you. Therefore, 50,000 expenditure will be disallowed over here. Next, you are making some payment of 60,000 rupees to a road transporter. Now, generally, if you make a payment to a road transporter, you are supposed to deduct TDS under 194C. But there is a relaxation that if the road transporter does not own more than 10 goods carriage at any time during the previous year, and he gives a declaration that he does not own more than 10 goods carriage, and he gives a PAN, then I am not supposed to deduct TDS. All those things are happening here. He is following 44AE. He does not own more than 10 goods carriage. He is giving a PAN. He is giving a declaration. Therefore, there is no need to deduct TDS. And even if you have not deducted the TDS, the expenditure will be fully allowed to you. Don't worry. Next, bonus of 4,48,000 is debited to PN. Now, we all know that bonus to employees are allowed on payment basis, payment basis, payment basis. As per 43B, you should pay till the due date of filing of return. Now, when have you paid? You have paid after the due date of filing of return on 18 December. Therefore, this bonus will be disallowed under the income tax law. Next is income tax. Income tax is disallowed. The interest of income tax is also disallowed under section 48(2). Both of them are disallowed. Next is you are giving some donation to a university which is approved under 35(1)(2). That is Scientific Research Association. Therefore, that is not allowed in 115BAA, therefore disallow that. This donation to Scientific Research Association is disallowed under PGBP under 115BAA. Under normal provision it is allowed, under 115BAA it is not allowed. Just comment below and let me know whether the voice is properly coming or not. Please, somebody is saying that voice is not coming. So if there is any issue, let me know. Okay. Next one, depreciation of 18 lakh rupees as per Income Tax Act is there. So you can claim the deduction because this information is given in additional information. You have to separately compute. Now, some mistakes they have done. Let's see whether that is a mistake or not. Now, on printer and scanner and EPBX, they have claimed 40% depreciation. Whether printer and scanner are eligible for 40% depreciation, the answer is yes. Printer and scanner are considered to be peripheral of computer. Computer and its peripherals both are subject to 40% depreciation. Therefore, printer and scanner 40% is okay, but EPBX 40% is not okay. On EPABX, only 15% depreciation is allowed. Therefore, you have to add back 25% depreciation over here and disallow 25% depreciation. Printer and scanner 40% is okay. EPABX 40% is not okay. There 25% you have to add back. Next one, additional depreciation you have not considered. Good enough, you have not considered additional depreciation because in 115BAA additional depreciation is not allowed only. Therefore, it is better that you have not considered what? Additional depreciation. I hope it is clear to all of you. Next one, you have done some provision for audit fee in the last year of 1 lakh rupees without deducting TDS. So in the last year you have made one journal entry and you have not deducted the TDS. So in last year 30% of the audit fees would have been disallowed, but in the current year you have deducted the TDS and you have paid the TDS. Therefore, in the current year you should get the deduction of that payment of TDS. Therefore, in the current year you can claim 30% deduction. Very simple. Last year 1 lakh rupees you have not deducted the TDS. Therefore, last year 30% of 1 lakh would have been disallowed, but in the current year you have paid the TDS. Therefore, 30% of 1 lakh will be allowed to you in the current year. Similarly, last year there was an outstanding expense of 90,000 rupees on which you have claimed the deduction for purchase of raw material. You would have purchased some raw material by passing journal entry. Purchase account debit to creditors account 90,000 rupees. Now in the current year you are making the payment by cash. 45,000 you have paid by cash. That is wrong. So if you claim deduction of an expense on accrual basis in 1 year, and in the next year if you make the payment by other than account pay check, account pay draft, ECS and such other electronic mode, in the next year it will be added to your income and it will be called as deemed income. I hope it is clear to all of you. Next adjustment is of no use to us. Earlier it was relevant, now it is not relevant. You are issuing some shares of 1 lakh rupees at rupees 90, whereas the fair market value is 60 rupees. Before 2024, there was a concept of angel taxation. At that time, it was relevant. Now it is not relevant, so ignore that. Okay. Now, apart from this, one last adjustment is there. Point number 8, you are declaring an interim dividend of 5,20,000 rupees in September. So it is good that you are declaring the dividend 1 month prior to the due date of filing of return. Therefore, you can get the deduction under ATM. ATM, you can get the deduction, but how much? Dividend received minus dividend paid, whichever is lower. So dividend received is how much? 4.8 lakhs. I have already told 6 lakhs minus 1,20,000 interest expense. 4.8 lakhs is the dividend income. And how much is the dividend expense? The dividend expense is 5.2 lakhs. Therefore, whichever is lower, that is 4.8 lakhs, will be allowed as deduction to you in this case. Now, after that, you will compute the tax. There are two types of income. One is LTCG, which will be taxable at 12.5%, and other incomes will be taxable at 22%. And on the total tax, you will impose 10% surcharge and 4% cess. So this is what this beautiful question is all about. Now, coming to the next question. Question number 2. Question number 2. It's a question on partnership firm. There are 3 partners, Vatsal, Vihan and Vayu are equal partners. The firm was formed in 2026, this year only. So it's a 10-year-old firm, 10-month-old firm, just 10-month-old firm. Now, what are you supposed to compute? You are supposed to compute just total income of the firm. No need to compute any tax, no need to compute any AMT, nothing, only total income. So whenever you compute total income of a firm, you have to compute first of all the book profit as per 40B. Then you will compute remuneration. allowable to the partners, and then you will compute the total income. So let's compute all of them one by one. Net profit is 4,50,000. What is book profit? Book profit is nothing but PGBP only. In that PGBP, just add the remuneration if debited to PNL. So net profit is 4,50,000. The first item is depreciation on generator and computer, which is as per books of accounts, so add back. Second is partner salary, add back. How many partners? 82,000 salary, 3 partners for 10 months salary, add back. This is the actual salary. This is not allowed. This actual will be compared with maximum percentage allowed as per 40B, whichever is lower, that will be allowed. That we will see later on. Then 18% interest you are giving. Therefore, 6% interest disallowed, only 12% is allowed. Then you are giving donation to political party. Now you are giving 2 donations. One you are giving by cash. Cash is fully disallowed. One you are giving 70,000 by electronic mode. This will also be disallowed in PGBP, but later on. This electronic payment donation will be allowed as deduction under 80GGC. Later on, you can claim that as a deduction. Again, I am saying cash donation disallowed now also, and in 80GGC also disallowed. But the electronic donation, online donation which you have given will be disallowed in PGBP, but under 80GGC you can claim that later on. Be careful. Next, you are paying some rent to partner Vatsal. Now, firm and partner are always related party as per 48 to remember. You cannot make payment in excess of fair market value to your partners. What is the market value of the rent? The market value of the rent is 15,000. How much you are paying? You are paying 36,000 to the partner. How much excess you are paying? You are paying excess of 21,000. For how many months? For 6 months. Add back that as per 48.2. You cannot make excess payment to partners in excess of fair market value. Therefore, the excess portion will be disallowed under 48.2. Next one, you are giving some benefit and perquisite to your customers in the form of gold coins. The gold coins are not exceeding worth rupees 10,000 rupees. So the value of the gold coin is up to 10,000 rupees. And you have not deducted TDS. Is it okay? Yes, it's okay. When you give any benefit and perquisite to any person in business and profession, you should deduct TDS under 194R only if the benefit and perquisite exceeds 20,000 rupees. If the benefit and perquisite does not exceed 20,000 rupees, the TDS under 194R is not applicable. Now, because the TDS under 194R is not applicable, therefore the expenditure should be allowed, even though you have not deducted the TDS, because the provision of TDS is not applicable only in your case. Next, tangible assets depreciation 243 you can claim. And last but not least, you have purchased some trademark in July, but you have put to use in December. So you should claim 12.5% intangible asset depreciation because the asset is put to use for less than 180 days. You can claim 12.5% depreciation. After that, you compute book profit. And then find out the remuneration maximum allowed. Up to 6 lakh book profit, 90% of book profit. Above 6 lakh, 60% of book profit. Compare that with actual. Actual is how much? 82,000 into 3 into 10. Whichever is lower will be allowed. And then you compute the total income, gross total income. And after that, you reduce the chapter 6. In chapter 6, only one item will come. What is that one item? That's 70,000 rupees electronic donation given to a political party. Cash donation not allowed. That's it. They have not asked tax, so we are not computing tax. They only asked for total income, so I have computed the total income. I hope it is clear to all of you. Let's go ahead with the third question now. That third question is on charitable trust. There is a charitable trust registered under 12AB. The income of the trust is 500 lakhs. Now the trust is giving donation of 200 lakhs to another charitable trust. Now we need to identify whether this donation given to another charitable trust, which is also registered under 12AB, is it allowed or not in following circumstances. Circumstances number 1. Point number 1. If it is given as a general donation, not as a corpus donation. So if it is given as a voluntary donation to another charitable trust registered under 12AB, not as a corpus donation, is it allowed? The answer is yes, it is allowed. Voluntary donation given to another charitable trust registered under 12AB or 1023C is allowed, provided it is only allowed to the extent of 85% of donation given. You will not get more than 85%. If you are giving donation of how much? 200 lakhs in this case, you will get 85% of 200 lakhs, that is 170 lakhs. Second, in case 2, if this donation is given as a part of a corpus, then it is not allowed. Corpus donation given to another charitable trust not allowed as deduction. Corpus donation given to another charitable trust not allowed as deduction. Be very careful. Third part, will your answer change if the donation is given out of the accumulation of last year's? If this 200 lakhs is not given from current year income, but it is given from the accumulation of last year, it is not allowed. It is not allowed from both the cases. The donation should be given from the current year's income. If it is given from last year accumulation, it will not be allowed, and voluntary donation also not allowed. Corpus donation anyways not allowed. Next, part 2. The trust has received some corpus donation. Okay. We are supposed to identify what are the conditions subject to which corpus donation will be exempt, and what if they do not fulfill the condition, then what will happen. See, if you receive any corpus donation from any person, as a trust, it will be exempt only if you deposit that corpus donation in the mode specified in 11.5. So if you deposit that corpus donation in the mode specified in 11.5, it will be exempt. And if you deposit that anywhere else other than mode specified in 11.5, it will be taxable, and it will be taxable under 115 BBI at flat 30%. It will be considered as violation of 115 BBI. So the rule is very simple. When you receive corpus donation, deposit in the mode specified in 11.5, and if you do not deposit in the mode 11.5, then it will be taxable at 30% under 115 BBI plus surcharge if applicable plus cess. No deduction of any expense will be allowed under 115 BBI. I hope it is clear to all of you. Let's go to next question. Question number 4. In question number 4, we are supposed to compute Mr. Amit, an Indian resident, his tax payable. Whenever tax payable will come, always remember you have to reduce from the tax liability, advance tax, TDS and TCS. Then only tax payable will come. Mr. Amit is opting for option to shift out of the 115 BAC. It means he is following old regime. So you have to compute tax as per old regime. Let's try to understand what Amit is doing. Amit is purchasing some virtual digital assets like cryptocurrencies and some non-fungible tokens also, NFTs. So Amit is purchasing some cryptocurrencies and NFTs. So what all things he has purchased? He has purchased one Bitcoin for 60 lakh rupees, first thing. Then his friend Sushil has given one NFT whose market value is 5 lakh rupees on his birthday, second thing. Then Amit also bought one NFT for 10 lakh rupees. So Amit has bought one Bitcoin, then he got one NFT as a gift from his friend, and then he bought another NFT. Now, what is due to financial need? Amit needs some money. Therefore, he has sold half Bitcoin. So for half Bitcoin, how much capital gains or how much gain will come? See, half Bitcoin is sold for 28 lakhs. What is the cost of the Bitcoin? The cost of one Bitcoin is 60 lakhs. Therefore, half Bitcoin will be 30 lakhs. Therefore, there is a loss of 2 lakhs. What is the treatment of this loss? Lapse. As per 115 BBD. Whatever loss comes in Bitcoin, whatever loss comes in virtual digital asset, it is not allowed to set off against any other income. It is not allowed to set off against this income also. This is lapse. Loss, there is no treatment for loss. This is gone forever. What is the next income for Amit? The next income from Amit is the gift from friend. If I receive a virtual digital asset whose market value is more than 50,000 rupees, that is taxable as income in my hand. Therefore, this 5 lakh rupees will be income in my hand. Because Mr. Sushil, who is my friend, he is giving me NFT of 5 lakh rupees on my birthday. So this 5 lakh will be income from other source. Apart from that, this NFT which I have received as a gift from my friend that I am selling later on for 6.5 lakhs. Check. So 6.5 lakhs will be the sale consideration of this NFT, and the cost of acquisition will be the FMV taken in 56,210. The FMV taken in 56,210 is 5 lakhs. Therefore, this 1.5 lakhs will be subject to 30% tax. And one more thing, Amit also has some other income of 6.5 lakh. So what is the total income of Amit? 4 calculations Amit has made. First, half Bitcoin, there is a loss. This loss is lapsed. Then 5 lakh rupees IFOS, that will be chargeable at normal slab rates, old regime. 6.5 lakh other income, that will also be chargeable at slab rates, old regime. This 1.5 lakh which is on transfer of NFT, this will be taxable at flat 30% without any exemption. Flat 30%. Even transfer expenses are not allowed for Bitcoins and virtual digital asset. Transfer expenses not allowed. Sorry. This transfer expenses are not allowed for Bitcoins and virtual digital asset. I hope it is clear to all of you. Now, they have asked for tax payable. I need to know tax payable. Is there any TDS deducted in case of Mr. Amit? Yes. When Mr. Amit has sold his Bitcoin for 28 lakh rupees and his NFT for 6.5 lakh rupees, so total 34.5 lakh rupees he has sold virtual digital asset, the buyer would have deducted TDS at the rate of 1%. On how much amount? When he sold 28 lakhs Bitcoin, on that 1% TDS would come to 28,000. When he sold NFT of 6.5 lakh, 1% TDS will come to 65,000, 6,500. Therefore, total 34,500 TDS would have been deducted by the buyer on sale of Bitcoin and virtual digital assets. Therefore, this should be taken as a credit while computing the tax payable. I hope it is clear to all of you. All these small points, you need to be very careful with it. Next question, again very intelligent question. There is a partnership firm by the name called as Pal & Company, in which Mr. Vivek is a non-resident partner. And this Mr. Vivek, non-resident partner, has put capital of 50 lakh rupees in the firm. Now the firm is giving him interest at the rate of 10%. The firm is also giving him share of profit. So the firm is giving him two things. Rate of interest is giving and share of profit. So I am a firm, you are a partner. You are a non-resident partner. I am giving you interest. I am giving you share of profit. I need to comment whether I should deduct TDS or not. So on interest, I should deduct TDS under section 194T, new section introduced from 1st April 2025. Why? If a firm pays interest, remuneration, commission, bonus, salary to the partner, then the firm should deduct TDS at the rate of 10% if the amount of payment exceeds 20,000 rupees in a financial year. So I should deduct TDS at the rate of 10%. When? At the time of credit to partner account or at the time of payment, whichever is earlier. Threshold is 20,000. So I should deduct TDS at the rate of 10%. What about share of profit? On share of profit, TDS is not deductible because share of profit is exempt in the hands of partners. Therefore, on share of profit, there is no need to deduct any TDS. But on share of profit, you should do related formalities like Form 15 CACB. You have to fulfill all these things. Okay. Now, there is another transaction over here. Mr. Vivek's friend is also there, Mr. Vikas. He is also non-resident. Now, he is providing some technical services to Pal and Company relating to project in India. So, Vikas is doing what? Vikas is doing some technical services he is giving to Pal and Company for some projects in India. So, this technical services, FTS, fees for technical services, is deemed to accrue or arise in India because the project is in India. The services are utilized in India. Therefore, it is deemed to accrue or arise in India. Now, in this case, is this amount taxable in the hands of Mr. Vikas? There is no DTAA between India and country X. Let's assume that. Now, therefore, this particular transaction is taxable definitely. Non-resident providing some FTS services for projects in India, it is deemed to accrue or rise in India as per 917. This is definitely taxable in India. Now, the question is, taxable as per what? 115A will not be applicable. Why 115A will not apply? Because for 115A to apply, there has to be an agreement between both the party and that agreement should be approved by central government. All those things are not there here. Therefore, 115A will not apply. Therefore, normal provision will apply. Normal provision means I have to deduct tax as per rates in force. What is the rates in force? The maximum rate which is applicable to individual is 30%. I will deduct TDS as per what? 31.2%. I hope it is clear to all of you. I will deduct TDS as per 31.2% and give the balance money to Mr. Vikas. Now, in second part, it is given. And where I will deduct TDS? I will deduct TDS under 195. 115A is not applicable as there is no agreement which is approved by central government. Second part is a very intelligent part. If India has a DTAA, let's assume in part 1 we have assumed that India does not have DTAA with country X. But part B we are assuming if India has a DTAA with country X and FTS is taxable at 10%, for example, then what is the remedy available to the payer, Mrs. Pal and Company, if Mrs. Pal and Company India has deducted tax at the requisite rate provided under the Income Tax Act? So let's assume that India and foreign country has a DTAA and the tax is taxable, the FTS is taxable at 10%, but still Mrs. Pal and Company has deducted tax as per income tax rate of 30%. Then what is the remedy? In that case, there is a remedy available to Mrs. Pal and Company under section 239A with one assumption. The assumption is if the tax is borne by Mrs. Pal and Company, if the tax is borne by the payer, if the tax is paid by the payer by grossing of the income, then Mrs. Pal and Company will get remedy under 239A. What is that 239A remedy? The remedy is Mrs. Pal and Company has to make an application to the assessing officer within 30 days from the date of payment of tax for refund of remaining 20%. And the officer will grant refund of remaining 20% within 6 months by passing an order. But this remedy is only available to Mrs. Pal and Company. See, very simple. If Mrs. Pal and Company has borne the tax, then Mrs. Pal and Company deserves to get the refund. If the tax is borne by Mr. Vikas, then Mr. Vikas deserves to get the refund. So Mrs. Pal and Company will get remedy only if Mrs. Pal and Company has borne the tax. Otherwise, Mrs. Pal and Company will not get the remedy. I hope it is clear to all of you. This 239A is applicable only if the tax is borne by the payer. Go and check this provision we have done, I think on the last page of the non-resident taxation or second last page, either of the two page in our color book. Next question, question number 6. There is a buyer, Mr. Bhuvan, and there is a seller, Mr. Srinivas. The buyer is purchasing some raw material from Srinivas. Now the seller is insisting that make the payment in cash of 3,20,000 rupees for an invoice. So the buyer made the payment in cash. Now what is the treatment in the hands of Mr. Buyer and in the hands of Mr. Seller? See, very simple. You cannot, for buyer I am saying, for buyer this 3,20,000 paid in cash will be disallowed under 40A3. Buyer cannot make the payment in cash in excess of 10,000 rupees. In excess of 10,000 rupees, if you want to pay to a person in a day, you should pay by 4 modes: account pay check, account pay draft, ECS, and such an electronic mode. The buyer cannot make the payment in what? In cash. So for buyer, the expenditure will be disallowed under 40A3. What about seller? Seller also cannot receive 2 lakh or more in cash in one entire day. or with respect to one invoice in multiple days. Seller also cannot do that. If seller does that, seller will be liable for 269 ST and the penalty will be imposed under what? 271 DA. 269 ST will be attracted and penalty will be imposed under 271 DA. The assessing officer will impose the penalty from 1st April 2025. Earlier, Joint Commissioner used to impose. Now, all assessing officers can impose. Now, second part of this question. Will your answer change? If purchases are done on two different dates, 1,80,000 separate invoice, 1,40,000 separate invoice. In the hands of buyer, again, no effect will be changed. Nothing will change. The buyer will be subject to disallowance of entire amount. Because for buyer, more than 1,000 rupees more than 10,000 rupees in a day should not be paid by other than 4 modes. So for buyer, 1,80,000 is more than 10,000. 1,40,000 is also more than 10,000. So for buyer, both the expenditure will be disallowed. What about seller? Seller will be escaped from 269 ST and 271 DA. Why? Because the transaction is happening on 2 different days. And on every day, the transaction value is not exceeding 2 lakh rupees or more. Therefore, seller will be escaped from 269 ST and 271 DA. I hope it is clear to all of you. Next question, which is on DTAA. Let's try to understand what is this DTAA question. Mrs. Sudha Sharma is 61 years age. She is a classical singer. She does concerts in India and country M. She visits country M every year for a few days. Therefore, majority of the time she is in India. Therefore, she is resident and ordinary resident, 100%. There is no doubt about it. Now, which regime she is following? Let's try to understand. She is trying to follow. We need to compute total income, net tax liability. If she opted out of default regime, it means she is following old regime. We need to follow old regime for her. Now, let's try to compute the total income of Miss Sudha. Now, which all income Sudha is earning? First of all, she is performing some concerts in India. 10 lakh rupees she is earning. You will put this in PGBP. Then another 12,245 from concert she is earning in country M. So you will convert that into rupees as per TTBR on the last day of the financial year. As per Rule 115. Rule 115 says that for conversion of foreign PGBP income into INR, you have to take TTBR on the last day. What is the TTBR on the last day of country M? For country M, the TTBR on the last day of the financial year is 80 rupees. So you will convert this as per 80 rupees. Then she also earns 10,000 rupees from country N, which is with respect to what? Which is with respect to again copyright. So this will also be converted as per TTBR on the last day of the financial year of country N. So for country N, the last day TTBR is 79. You will multiply this by 79 and you will take in India. Then she is earning some fixed deposit interest, 4 lakh rupees on that and 25,000 rupees interest from saving bank. And from this 4 lakh and this 25,000 rupees, she will get 50,000 rupees deduction under 80 TTB because she is a resident senior citizen and she will get deduction under 80 TTB, not 80 TTA. Then she pays medical insurance of 25,000 for herself and 30,000 for her resident husband. Therefore, herself and husband taking together, she can claim 50,000 rupees limit deduction under 80D for mediclaim because she is following old regime. And she deposits 1.5 lakhs in PPF, so she can claim deduction under PPF 1.5 lakhs under 80C. And then she makes 3 lakh rupees 5-year FD in the name of son. In the name of son, if you make an FD, you are not eligible for deduction. You should make in your own name. So if you make in the name of your son, then it is not allowed. Now, one important thing we need to understand. With country M, we don't have DTAA, but with country N, we have DTAA. Therefore, with country M, we don't have DTAA. Therefore, the income will definitely be taxable in India, and country M also in India will give relief. What about country N? Country N, we have DTAA. Therefore, we need to identify this country N income is there, na? This $10,000, it is taxable in India or not? We need to understand Article 12 of DTAA between India and country N. For that, royalty and fees for included services arising in a contracting state. Where it is arising? It is arising in country N. It is accrued in country N. Paid to a resident of other contracting state. Where is the resident located? In India. Paid to a resident of India may be taxed in that other state. It means it may be taxed in India also. Therefore, this royalty will be taxed in country N also, and this royalty will be taxed in country India also. Therefore, we will include in India and we will give relief as per Article 23A, Article 23, elimination of double tax, which is similar to Section 91 unilateral relief only if you read this paragraph. So now we have included all the income. Concerts, Indian concerts 10 lakh. Royalty from country N will be taxable here also, there also. Royalty from country M, concert from country M will be taxable here also and there also. Then fixed deposit from Indian bank, and then bank account, saving bank account interest. From that 80C deduction, 80 deduction, 80 TTB deduction. After that, I will get 29,44,600 as total income. I will apply slab rates as per old regime because the assessee is following old regime. Old regime, Senior citizen, therefore up to 3 lakh rupees, no tax. Above 3 lakh 5%, above 5 lakh 20%, and above 10 lakh 30%. Therefore, my tax is coming to 693 plus cess 721 is my tax. Therefore, average rate in India is 24.489. Now I will compare this average rate in India with average rate in foreign country, and I will give the FTC. Now I will go by country by country. Now in case of India and country N, what is the doubly tax income? In case of India and country N, the doubly tax income is 7,90,000. Therefore 7,90,000 into India's average rate. This is one tax. Compare with the tax paid in country N. What is the tax paid in country N? Whichever is lower, that will be allowed as deduction. The tax paid in country N, you have paid tax at the rate of 10% of 10,000. 10% of 10,000 is $1,000. Now this $1,000 you have paid on 25th of March. So this you have to convert into rupees as per Rule 128. What does Rule 128 says that? Rule 128 says that you have to convert the foreign tax into Indian tax for the purpose of credit as per TTBR of the last day of the preceding month. So you are paying in March 25. So you have to take 20th Feb TTBR. What is 20th Feb TTBR in country N? The 20th Feb TTBR in country N is 78 rupees. Therefore, you have to convert this into 78 rupees, and this 78 rupees will be considered as foreign tax, and you will compare your Indian tax with your foreign tax, and whichever is lower will be allowed as deduction. So always remember, for converting foreign income you apply Rule 115, but to convert foreign tax you apply Rule 128. Similarly, for country M, what is the doubly tax income? For country M, the doubly tax income is 979,600. So I will write 979,600 over here into what is the average rate tax paid in India. It is 24.489, that is 239,894. And what is the tax paid in foreign country? We need to again check over here. They have given the data of tax paid in foreign country. In country M, you have paid $2,500 in the month of October. So you have to again take the TTBR of 30th September. The TTBR of 30th September in country M is, in country M, the TTBR of 30th September is 80 rupees. So you will convert this $2,500 into 80 rupees, and therefore as per 80 rupees it will come to how much? It will come to 2 lakh rupees. Check please. So you will take this as 2 lakh rupees, you will convert this into 80 rupees, and this will come to what? This will come to 2 lakh rupees. Therefore whichever is lower will be allowed as relief, and ultimately these two reliefs will be reduced from your tax, and therefore net tax payable will be 443,120 after rounding off. I hope it is clear to all of you. Very good question. Question number 8. Sir, what is question number 8? Again, you will need to find out the tax liability of Mr. Manan under default regime, under new regime. What is Manan doing? Manan was staying in country X for a long time. Now he came to India permanently on 1st February 2025. That is last year. Just 1 month back, just 2 months back, he has come to India permanently. Therefore, Manan is staying in India in the current year for 365 days, and in the last year only for 60 days. Therefore, Manan is definitely resident, but Manan is not ordinary resident, but because Manan will not fulfill the additional conditions of ordinary resident. What is the additional conditions of ordinary resident? He should stay in India for 730 days in last 7 years. That is not going to happen. He was permanently settling outside India. Now he has come to India just 60 days back. Plus, he should be resident in India in at least 2 out of last 10 years. That is also not possible. Therefore, Manan is resident but not ordinary resident. Now, we need to understand which incomes of resident and not ordinary residents are taxable in India. Only incomes which are accrued in India or deemed to accrue in India, or only incomes which are received or deemed to receive in India. And in case of PGBP, if the business is done outside India but controlled from India, or if the profession is done outside India but set up in India, only then it is taxable. If an income is accrued outside India, received outside India, then that is not taxable for NOR. That is only taxable for R and OR. Therefore, Manan is earning what? Manan is earning some rental income from country X. See, the rental income from country X will not be taxable in India. Why? Because this is accrued outside India. This is received outside India in the bank account in country X. Therefore, that will not be subject to tax in India. What will be taxable in India for Manan is only the business income in India of 12,50,000. That Manan will pay tax in India. And along with that, Manan has purchased some land in Indore on 18th of March 2023 for 30 lakhs. Now Manan is selling that land on 23rd of December 2025 for 80 lakh rupees. So this land is sold after 24 months, and this land is situated in India. Therefore, this capital gains will be chargeable to tax in India. Okay. Now, but on this 50 lakh rupees, Manan has two options. That's the catch in this question. Which two options? Which two options? The two options which is given to the grandfathering assessees. That is, if an assessee is resident and he is purchasing land and building before 23rd July 2024 and he is selling land and building on after 23rd July 2024, then he has two options. He can take 12.5% without indexation or 20% with indexation. Manan has both the options. Check. So on LTCG, you will apply both the option, whichever is beneficial, you will take that. And on business income, you will apply slab rates as per new regime. I hope it is clear to all of you. That is the reason they have given you indexation also. All this TTBR, TTSR is not useful. It is for time pass. It's of no use to us. I hope it is clear to all of you. And one last question over here in this particular RTP. It is a very big RTP. One of the best RTPs out of 9 RTPs is this one. It's very big and all questions are also very good. So there is an Indian company, Triveni, Triveni Cement Limited, TCL, and which is having a head office at Chennai. Now, there is a foreign subsidiary Drift Inc. which is of Triveni. Therefore, that Drift Inc. and Triveni are what? Associate enterprise. Now, Drift is paying some royalty. Drift is paying some royalty of $3 million to Triveni. So, Triveni is providing some services. Drift is paying royalty of $3 million to us. Whereas Triveni is receiving royalty from others at $4 million. So, I am Triveni from associate enterprise Drift Inc. I am taking $3 million. But from others, I am taking $4 million. From associate enterprise, I am taking $1 million less. $1 million means 10 lakh. $10 lakh less I am taking. Therefore, that much I have to add back. $10 lakh into 82 rupees is the rate of dollar which is given over here in the question. Where it is given, 82, somewhere it is given. Here it is given. So 10 lakh into 82, that will be added back. Again, I am saying, I am Triveni, I am in India. When I am giving services to my associate enterprise Drift, so I am taking $3 million. When I am giving services to third party, I am taking $4 million. Therefore, I am taking $1 million less from associate enterprise. That I have to add back into 82. Therefore, I have to add 820 lakhs over here. Second issue, TCL has borrowed 220 crore from Swift Inc. So whether TCL and Swift are deemed to be associate enterprise? If yes, whether transfer pricing adjustment will be met? Yes, TCL and Swift are deemed to be associated. Why? See, TCL has taken how much loan? 220 crore. And the balance sheet of TCL says that the book value of the asset of TCL is 330 crores. So out of 330 crore asset of TCL, 220 crore they have taken as a loan from Swift, which is 67% approximately. Therefore, if one entity finances 51% of the book value of the asset, market value is not relevant for me, then both of them are deemed to be associate enterprise. Therefore, TCL and Swift are deemed to be associate enterprise. Now, we are paying how much interest? We are paying how much interest to Swift? We are paying 8% interest to Swift, whereas the market rate is 7%. So, we are paying 1% extra. We are paying 17.6 crore. Therefore, 17.6 crore we are paying at 8%, which is 1% extra. Therefore, 1% is how much? Cross multiply. That will be added back to your income statement as a transfer pricing adjustment. So, to our associate enterprise, we are paying 17.6 crore, which is 8%. To others, the normal rate is 7%. Therefore, 1% extra. Therefore, add back. Third transaction. TCL supplies goods to True Words Limited. The paid up capital of True Word is 92 crore and TCL holds 22 crores. So let's check how much percentage it holds. So 22 crore divided by 92 crore comes to approximately 23.91%, approximately 24%. Therefore, they are not associate enterprise. Because they are not associate enterprise, transfer pricing adjustment cannot apply in this case. I hope it is clear to all of you. So out of 3 transactions, 2 transactions are subject to transfer pricing, 1 is not subject to transfer pricing. So this is what this RTP is all about. How did you like the RTP? Please comment below. First of all, when I don't come for full English lecture, you guys say eat my head by saying, sir, full English, full English, full English, full English. And when I come with the lecture, you don't reply. You don't reply only. You don't attend only lectures. I will not upload full English lectures now. Go. Just a second. Let's go ahead with the next RTP, that is RTP September 2025. Again, the first question is on total income. Now we need to read the last line. We have need to compute total income. As per the normal provision, do not go for 115 JB or do not go for concessional tax regime. Nothing has to be done. Just total income as per the normal provision. Not even tax computation is asked. Okay. So let's start with the first adjustment. Assassi is a company, Rainbow Limited. The profit of the Assassi is 27,22,000 rupees. The very first adjustment is Assassi has taken some loan for purchasing some land. On that land, they will construct some factory building. They will construct some factory building for which approval is not yet received. So because the approval is not yet received, whatever interest you have incurred on loan, that will be capitalized. Okay, that will not be allowed as deduction. That will be disallowed over here. Whenever the building will be ready, at that time the interest will be capitalized till the time the building is not put to use. Till the time the building is put to use, after that interest will be allowed as deduction. So as of now, because the building is not ready, the approval is not received, you have to disallow this interest. You have to capitalize this interest. Whenever it will be ready in the next year, that time you can claim that as a depreciation. Okay. Next one, you have paid some commission of 1 lakh rupees in the month of February. You have deducted TDS in February and you have paid the TDS in September. Absolutely correct. When you want a deduction of an expense, you should deduct the TDS in the same financial year by 31st of March and you should pay till the due date of filing of return. Therefore, in this case, the assessee has deducted the TDS before March but paid and also paid till the due date of filing of return. Therefore, this 1 lakh rupees will be allowed as deduction. But the problem is with this 1,25,000 rupees. On this 1,25,000 rupees, which is paid in the month of March, the TDS is deducted in May. Now here they have made a mistake. The TDS should be deducted by March. If you don't deduct TDS by March, it will be disallowed in the current year. Even if you deduct the TDS of March on 1st of April, still in the current year, the expenditure cannot be allowed as deduction. Therefore, this 1,25,000, 30% will be disallowed under section 40A1A and in the next year, it will be allowed as deduction. This is disallowed because of late deduction. Okay. Now, you are incurring some travel expenses for foreign tour of director and directors are going outside India for new line of business. This is disallowed. Now, you need to be very careful. Don't get confused with something which we have done earlier. Whenever you incur some expenses for foreign tour for director, where the director goes outside India for existing business, then it is allowed as a deduction. Earlier, one adjustment has come similar. You will find that in that adjustment, you have allowed the year we are disallowing, both are different. There, the directors were going for existing business. So, if the directors are going for existing business, it will be allowed. But if the directors are going for new business, it will be disallowed. Okay. Next one, there are some outstanding interest of 3 lakh rupees. Now, the company is converting that outstanding interest into a new loan. conversion of outstanding interest into a new loan does not amount to actual payment, therefore that conversion will be disallowed. However, that new loan, whenever that new loan will be paid, that will be allowed as deduction. So how much you have paid? You have paid 50,000 out of that. Therefore, the 50,000 rupees will be allowed as deduction. So 3 lakh rupees will be disallowed and 50,000 will be allowed as what? Deduction. I hope it is clear to all of you. Next one, EPBAX and mobile phones, they are subject to 15% depreciation, but mistakenly you have taken 40% depreciation. Therefore, 25% depreciation on EPBX and mobile phone will be disallowed. So 25% you have to disallow. Okay. Next one, there is a wholly owned subsidiary over here, S Limited. Now you are giving a contribution, you are giving a donation of 5 lakh rupees to that wholly owned subsidiary. For what? For construction of school. For whom? For the benefits of the employees. So this is allowed as deduction. There are some high court judgment which says that if you give some donation to your wholly owned subsidiary for the welfare of the employees, for construction of school, ultimately it will help in welfare of the employees, which will help in the business. Therefore, it shall be allowed as what? It shall be allowed as deduction. Next one, dividend you are receiving from a company. So whatever dividend you are receiving, reduce from here and show under PGBP. How much dividend you are receiving? 10,000 the equity shares into 10 rupees each. Therefore, 1 lakh rupees dividend you are receiving, reduce from PGBP, show under IFOS. Okay, do not gross up, do not gross up. See, ICI has been taking a stand that nowadays ICI does not gross up dividend unless and until it is written in the bracket that it is net of TDS. Unless and until it is written net of TDS, don't gross up. Earlier they used to gross up dividend received every time, but now they are not grossing up. Unless and until it is written, it is net of TDS. So please don't gross up. Okay. Then there is a grandfathering clause over here which you can apply. Reduce the profit from PGBP and show under what? Show under capital gains. How much is the profit? The profit on grandfathering clause capital gains is 3 lakhs. Reduce from here and show under capital gains tax at 12.5% in excess of 1.25 lakhs. Now, whenever the date 31st Jan 2018 will come, always remember there is a concept of grandfathering clause. Next one, very simple adjustment. There is a provision for gratuity as per actuary. So the provision for gratuity as per actuary of 6 lakh rupees will be disallowed under 47, and whatever you have actually paid will be allowed. So actual paid will be allowed and actuary provision will be disallowed over here. Last one or two adjustment, that is bonus of last year bonus 2024-25, which was paid on 15th of November 2025. So last year bonus paid in the current year. Therefore, bonus of last year will be disallowed in the last year because bonus is allowed on payment basis. Now last year it was not paid on time. Therefore, last year this 98,000 would have been disallowed. But in the current year it should be allowed because it is paid. But in that also you have made a mistake. You have paid 34,000 by bearer check. Therefore, I will not allow you full 98,000. Out of 98,000, 34,000 will not be allowed. Therefore, only 64,000 will be allowed. For 34,000, you can write a note that this will be not allowed because it is paid in bearer check. Okay. Last but not least, you have purchased some commercial vehicle of 8 lakh rupees on 21st of March 2026, and you have claimed full depreciation of 15%, which is wrong. You cannot claim full depreciation. You can claim only half depreciation, and this is also debited to the statement of P&L. If this would have not been debited, then it would have been a different case. But you have debited that to P&L. Now, because you have debited to P&L, you have to add back 50%. So you have wrongfully claimed 15%. You should claim only 7.5%. Therefore, 7.5% will be disallowed in this case. Okay, that's the only thing which is asked. No 115BAA, no MAT, no tax calculation also. Only total income as per the normal provision. I hope it is clear to all of you. Let's go ahead with the next question. Question number 2, which is on charitable trust. So there is a charitable trust registered under 12AB, engage in preservation of forest. The very first question over here is, they are following mercantile system of accounting. Now, they have incurred some electricity expenses of 1,20,000 in 25-26, but it was paid in 26-27 on 15th April 2026. So when they will get the deduction? See, always remember, for charitable trust registered under 12AB or 1023C, their deductions are allowed on payment basis. So even though the expenditure is of 25-26, but the deduction will not be allowed in 25-26, the deduction will be allowed in 26-27 only on payment basis. Trust get deduction on payment basis, not on accrual basis. This is the first point. Second, the charitable trust is earning some agricultural income of 10 lakh rupees, which is exempt under 10(1). Will they be eligible for this exemption? The answer is yes. Generally, if you are registered as a charitable trust under 12AB, then section 11 subsection 7 says that no exemption under section 10 will be allowed to a trust except 10(1). 10(1) a charitable trust can claim. So in this case, charitable trust can claim what? 10(1). They cannot claim other exemptions. So in this case, charitable trust, along with the exemptions of section 11, 12, they can also claim agriculture exemption under 10.1. So this is also correct. They can claim exemption under 10.1. Third one. The charitable trust has earned rental income of 4 lakh rupees. They have earned 4 lakh, out of which 3 lakh is received in the current year, 1 lakh is not received, 1 lakh is received in future. So you might have done one point with me in the class, that if you have not received a particular amount, then how will I apply? So you can make an application. The trust has make an application that whenever I will receive, I will apply at that time. So the trust has exercised for the relevant option. That 1 lakh rupees I have not received. Whenever I will receive, I will apply. So the law says that you should apply when you receive, or you should apply the year following the receipt. Otherwise, it will be deemed income of the year following the receipt. So 3 lakh rupees you have received. That's okay. You have applied. 1 lakh rupees you have not received. So you have made an application for deferral. You have made an application for deferral. You said that I will apply this in future. When have you received? You have received on 31st August 2026. Now what is your duty? Your duty is to apply by 31st March 2027 or 1 year extra grace by 31st March 2028. You should apply in the year of receipt or the year following the receipt. The year following the receipt is 27-27. So you should apply till 31st March 2028. If you don't apply till 31st March 2028, it will be deemed income of 31st March 2028. I hope it is clear to all of you. Question number 3. A similar question we have done earlier. Point number 1 we have done earlier, similar. Not exactly similar, but kind of similar. Mr. Raju is a buyer and Mr. Sandeep is a seller. Raju is buying some scrap of 55 lakh rupees. Now, generally, if a seller is selling scrap, then he should collect TCS under section 206C subsection 1. Because in 206C subsection 1, scrap is covered for TCS. So, Mr. Raju is buying some scrap of 55 lakhs from Sandeep. So, Sandeep should collect TCS technically. But Raju is resident. And Raju is saying that, no, this scrap I am not buying for my trading purpose. This scrap I am buying for manufacturing purpose. Or if Raju says, for example, I am buying this scrap for power generation, then in that case, Sandeep will not collect TCS as per 206C subsection 1A. That if a buyer gives a declaration that he will use this particular items for power generation or for manufacturing, that the seller should not collect TCS. Then in that case, it is the responsibility to deduct TDS under 194Q by buyer if the other conditions of 194Q are fulfilled. The buyer should deduct TDS in that case. Now let's see whether the buyer is liable for deducting TDS or not. Let's see whether the buyer is fulfilling the conditions or not. The buyer, Mr. Raju's last year turnover is more than 10 crore, check. So the buyer's last year turnover is more than 10 crore and buyer is buying goods of more than 50 lakh rupees. Therefore, buyer will be liable to deduct TDS in excess of 50 lakh rupees. That is on 5 lakh rupees, 0.1% at the time of credit or at the time of payment, whichever is earlier under 194Q. So in this question, seller is exempted from TCS, but the buyer is liable for TDS on 5 lakh rupees, 0.1% on credit or payment, whichever is earlier. I hope it is clear to all of you. Next one. Mr. Rajat has taken a loan of 12 lakh rupees from employer for what? For education outside India of his daughter. Out of that, he has remitted 9,75,000 to the university outside India. Whether TCS will apply or not. See, if you take a loan from employer, that is different if you take a loan from a financial institution in India. If I take a loan from a financial institution in India and then I send outside India for education purpose, then TCS is not applicable, only exempted. But if I take a loan from employer in India and then I send outside India, then TCS is applicable in excess of 10 lakh rupees. Up to 10 lakh rupees exempt, about 10 lakh rupees 5%. So here I am taking loan from employer, therefore I will not get complete exemption. I will get exemption up to 10 lakh, about 10 lakh 5%. So in this case, I have taken a loan of 12 lakhs, but I have remitted only 975. Now because 975 is less than 10 lakh, therefore here no TCS will be applicable in this case. I hope it is clear to all of you. Next one is something which we have done earlier also, but a very important case law of Travel Designer India Private Limited, Supreme Court judgment, recent judgment of 2025. What has happened in this case? The SSC has filed an original return on 15 September 2024. Then the AO said that there is a defect in this original return. So the AO has told to rectify the defect and the SSC rectified the defect in the next year. So the return is filed on 15 September 2024 and the defect is rectified in the next year on 19 May 2025. Now the question is, what is the time limit to send a scrutiny notice? The time limit to serve scrutiny notice is 3 months from the end of the financial year in which the return is furnished. Which return? Original return or rectified return? Original return or when the defect is cured. So the Supreme Court said that the 3 months from the end of the financial year in which the return is furnished will be counted from the year in which the original return is furnished and not the rectified return. So 3 months from the end of the financial year will be counted from 3 months from the end of the financial year in which the original return is furnished and not when the defective return is furnished. I hope it is clear to all of you. So this is what this question is all about. Next question, very simple question once again. It's a question on penalty computation. Mr. Kabir is following old regime. He opted out of default regime. Now his total income as per return is 35 lakhs. Then return is processed 45 lakhs. Then income is assessed 85 lakhs and income is reassessed at 1.05 lakhs. That is 1.05 crore. Sorry, that is 105 lakhs. Now we need to suppose to compute the total income. We are supposed to compute the penalty not on account of misreporting. It means penalty is 50%. Very simple question. First penalty will be imposed under 143.3 and then penalty will be imposed after 147. Under 143.3, how the penalty will be computed? Underreported income will be computed, step number 1. Then tax on underreported income, then penalty. What is underreported income? Income assessed minus processed. What is income assessed in 143.3? 85 lakhs. What is income processed? 45 lakhs. This 40 lakhs is underreported income. Now, will I compute tax directly on 40 lakhs? No, no. Never compute tax on directly 45 lakhs. 40 lakhs. First compute tax on 85 lakhs. When you compute tax on 85 lakhs, you have to apply surcharge of 10%. And then compute tax on 45 lakhs. When you compute tax on 45 lakhs, no surcharge. And then cess, and then you will apply 50% penalty. Similarly, underreported income at the time of 147. Income reassess 105 lakhs. Income previously assessed 85 lakhs. Check please. Reassess 105 lakhs, previously assessed 85 lakhs. Therefore, underreported income is 20 lakhs. Now, how will I compute tax on this? Will I compute tax directly on 20 lakhs? No, no, no. That is the catch. First, you will compute tax on 105 lakhs, then tax on 85 lakhs. Tax on 105 lakhs, when you will compute, you will apply surcharge of 15%. Tax on 85 lakhs, when you will compute, you will apply surcharge at 10%. And then you will compute the tax. On that, you will apply surcharge. On that, you will apply cess. I hope it is clear to all of you. And then you will apply 50% penalty. Next question is also a very good question. There is a foreign company which is incorporated in Belgium. This foreign company is doing two things. First, it is selling raw diamond in special notified zone. Very special notified zone. It is in Mumbai, Bharat Diamond Bourse, and in Surat Diamond Bourse. So this foreign company is selling raw diamonds in Mumbai and also in Surat. This foreign company is also displaying raw diamond in what? In special notified zone, that is Bharat Diamond Bourse, Mumbai and Surat. So now the question is, this foreign company is doing two things: selling raw diamonds in Mumbai, selling raw diamonds in special notified zone, and also displaying raw diamonds in special notified zone. Are they eligible for safe harbor rule? Now let me tell you who is eligible for safe harbor rule and who is not eligible for safe harbor rule. First of all, let me talk about the display point. If a foreign company comes to special notified zone and display the raw diamond and earn income, that is not considered as income accrue or deemed to accrue or rise in India. As per section 9, it is not taxable. And because it is not taxable, therefore they will not be liable to for safe harbor rule also. Someone who is not taxable, only the question of safe harbor rule will not come only. Second possibility, if a foreign company comes to special notified zone and sell raw diamonds, then safe harbor rule is applicable. And then the safe harbor rule is, whatever is the revenue of that 4% should be shown minimum as a profit. If you show lesser than 4%, safe harbor rule will not apply. If you show more than 4%, safe harbor will apply. Then you will not get deduction of any expenses. I hope it is clear to all of you. Question number 7, beautiful question. We have done a similar question earlier also, which was bigger than this, but this is also a good question. That is the reason I am discussing once again. Kanika is a resident. She is earning income from India, country X, country Y. Now she is following what? She is following default regime, new regime. We need to find out the net tax liability of Kanika. So let's try to compute the total income of Kanika first. In India, she is earning house property income of 4.3 lakhs. Directly income is given, therefore no need to take 30% standard deduction once again. There is a loss of 1.3 lakhs in 1.3 crores in foreign country. Therefore the net income is 3 lakhs. Then take 9 lakhs singing profession income, 2 lakhs singing profession income. Then 5.5 lakhs from the owner of cricket team Delhi Super Players. Then other businesses income you should take. Share of profit from country X is taxable. In India, share of profit is from a firm is exempt. From foreign country it is taxable. Agriculture income in India is exempt. Agriculture income in foreign country is taxable. You take a total of all of them, you will get somewhere around 35.6 crores. Now compute tax on this. How? Don't compute directly. Partial integration you have to apply, because there is an agriculture income in India which is exempt at the rate, which is exempt to the extent of 1.5 crore. Compute partial integration. How? Step number 1. Step number 1 will be tax on this plus agriculture income. Step number 1. Step number 2 will be tax on agriculture income plus basic exemption limit. Then the difference between both of them will be the tax. On that, you will apply 25% surcharge, because the income is more than 5 crore. In new regime, you will apply 25% surcharge, 4% cess. You will get your tax in India 13 crore 86 lakhs. You will get your average rate in India. Then you have to find out average rate in foreign country. Now, average rate in foreign country is not directly given. They have given you tax paid in country X and tax paid in country Y. Now, because they have given you tax paid in country X and tax paid in country Y, you can find out average rate. How? Tax in country X divided by income of country X, tax in country Y divided by income of country Y. Sir, how did you find out this income? By reading this paragraph. In country X, this loss is not allowed. See, in country X, it is written over here. Loss from house property is not allowed. Therefore, this loss will not be allowed to set off. In country X, this 7.2 crore is taxable. This 4.8 crore is also taxable. Therefore, in country X, 12 crore is taxable. Similarly, in country Y, this 2 crore is taxable, this 2.9 crore is taxable, and even agriculture income is taxable in country Y. Check. In country Y, agriculture income is taxable. Therefore, the total income of country X is 12 crore and the total income of country Y is 6.1 crore. You will get the average rate when you multiply by this, and then that average rate you will compare with Indian rate. What is the Indian average rate? 38.956. Whichever is lower, that you will apply on doubly tax income. How to compute doubly tax income? That everybody knows. Whatever is the doubly tax income, on that you will apply the lower rate and then you will get the relief. I hope it is clear to all of you. So this is what this RTP is all about. Let's go ahead with next RTP, that is RTP Jan 2026. The very first question over here is, pay attention please. You are supposed to compute total income, tax liability as per normal provision, also as per the concessional regime under 115BAA. And you are also supposed to say which option is beneficial. You are supposed to ignore MAT, no MAT is required. And the turnover of last year is 402 crore. Therefore, the tax rate over here will come to 30%. Okay. Now, let's start the question as per normal provision first, and then we will talk about in 115BAA which all items are not allowed. Okay. Now, the assessee is engaged in manufacturing some automobile items, and then the profit of the assessee is 8 crore 25 lakh. The very first adjustment is depreciation that you will add back. Okay. The next adjustment is you are giving some donation to a political party by account paycheck. Therefore, in PGBP it will be disallowed, but in Chapter 6A in 80 JGB, 80 GGB, you can take that deduction, because in normal provision it is allowed if you make the payment by online mode, but in 115BAA it will not be allowed. Okay, I am saying side by side 115BAA effect also. Next one, there is some long-term capital gain of 6,18,000 rupees on listed equity share on which STT is paid both at the time of purchase and sale. Therefore, this equity share, this long-term capital gains is covered in 112A. Therefore, reduced from PGBP 6,18,000, show under capital gains, and in capital gains 112A will apply 12.5% tax in excess of 1.25 lakhs. Okay. Next one is a very important adjustment for us. Very important technical adjustment. You have imported some machinery from Japan for 65 lakh rupees. And you have installed that machinery in December 2024. Be very careful. Very intelligent adjustment. You will say that, no, sir, we have done similar adjustment earlier. No. You have not done similar adjustment earlier. So you have imported some machinery from Japan for 65 lakh rupees in December. Now, you have made some foreign currency payment because you have done some hedging contract and there is a loss on foreign currency payment. So this loss, what happens? You have to add back this loss to PGBP. PGBP it will not be allowed as per section 43A, and you should add back this to the cost of asset and claim normal depreciation and additional depreciation. Now, but in this question, what you will do, you will just add back this loss of 2 lakh rupees to your PGBP income. Don't add back to the asset and claim normal and additional depreciation. Why, sir? We have been doing that earlier, sir. No, you don't do that, because in the additional information it is given that when you will take this depreciation now 1 crore 18 lakhs, that already includes the depreciation on imported machinery. Additional and normal depreciation both are already included in this 1 crore 18 lakhs. Now, when you will reduce 1 crore 18 lakhs, you will by default reduce the normal and additional depreciation on that entire machinery. So why are you doing it once again? So be very careful. What is the treatment of this? The treatment of this is very simple. Whatever loss is there, add back that. That's it in the normal provision. In 115BAA, whatever additional depreciation will come on this amount, that additional depreciation on 67 lakhs you have to add back. Okay, I hope it is clear to all of you. So again, I'm saying, first of all, this loss you have to add back. In PGBP, add back. Then don't claim normal and additional depreciation separately in normal provision, because that is already included in 1 crore 18 lakhs. But when you do 115BAA, just add back the additional depreciation on 67 lakhs, because in 115BAA, additional depreciation is not allowed as a reduction. Very important adjustment. Next one is also a very important adjustment. The assessee has borrowed some fund from Andhra Pradesh Industrial Development Corporation and some Andhra Pradesh State Financial Corporation. The total accrued interest is 11,56,900. Now, the assessee is converting this outstanding interest into equity shares. Is that allowed as a deduction? The answer is yes. If you convert an outstanding interest into a new loan, not allowed as deduction. If you convert an outstanding interest into a bond, debenture or any other security where the liability to pay is deferred to future date, then it is not allowed as deduction. But if you convert that outstanding interest into an equity share, it is allowed as deduction. Very recently, Telangana High Court has given a judgment that conversion of outstanding interest into equity shares will be allowed as deduction, because when you convert an outstanding interest into equity share now, there is no liability. The liability of the company is discharged. Company is not liable to pay anything to anyone now. There is no liability in the balance sheet which the company has to pay. Therefore, it is allowed as a deduction. Always remember. Okay. Next one is also very intelligent adjustment. Be very careful. You have taken a loan of 6 crore 74 lakh for acquiring a machinery. You have taken a loan on 1st of June 2023. Now, the machinery is put to use on 1st of February 2025. Okay. So, you have taken the loan on 1st February 2024, and after 8 months, the machinery is put to use. So, first of all, compute the interest of the machinery. 674 is the total loan, multiplied by 10% is the rate of interest, multiplied by 10 will be number of months from June to March, divided by 12. This is the total interest which is there. Okay. Now, first of all, add back this full interest. Why? Because this interest is not allowed as a reduction. It will not allowed as a reduction now. First of all, add back this full interest. Now, what will happen with this 10-month interest? From 1st June to 31st Jan, that is 8th month interest will be added to the asset, and you will claim depreciation and additional depreciation. Again, don't take separately while computing normal regime, because this also is already included in 1 crore 18 lakh check. Machinery purchase through borrowed from HDFC. This additional and normal depreciation also included. So what is the only treatment that you will give over here? You will add back. Okay, add back the addition, add back the entire interest, add back the entire interest to the PGBP, and whatever effect has to be done, that the company has already done while computing the depreciation. Don't give anything else. Okay, now out of this 56 lakh, how much will be added to plant and machinery? 8-month interest will be added to plant and machinery, 44.93, and the 2-month interest will not be allowed as deduction. Why, sir? Because the interest is paid after the due date of filing of return, therefore 2-month interest will not be allowed. Don't do all this calculation while computing normal regime. This is relevant for computing 115BAA, because in 115BAA you have to add back the additional depreciation. Therefore, while adding back the additional depreciation, you have to take the cost of asset as 674 plus 44.93. That will be added back, because that is the actual cost of the asset. I hope it is clear to all of you. Again, I am saying whatever interest is coming, whatever interest is coming, first of all disallow in PGBP. Okay, just that's the only thing you have to do under the normal provision. When you go to 115BAA, the 8-month interest you add to the cost of asset, and then you will get the actual cost of the asset. Of that, additional depreciation you will add back. Okay, additional depreciation you will add back 10%. Okay, I hope it is, because the machinery is put to use for less than 180 days. Now the next adjustment is a very simple adjustment. We have done this lot of time in the examination, in the class earlier, also in the paper also. You are giving some donation to a scientific research institution, so you can claim that deduction under the normal provision. Under 115BAA it will not be allowed. Okay, next one is also a routine adjustment we have done earlier. You have sold some goods of 18.5 lakhs. Out of that, 11 lakh has become bad debts. Now later on, therefore, now how much is the debtor in the balance sheet? Out of 18.5 lakhs, 11 lakh has become bad debt. Therefore, debtor is how much? 7.5 lakhs. Now the question is, out of this 7.5 lakhs, while recovering, now the debtor is dead, the debtor expired, the debtor passed away. Now you are fortunately recovering more than 7.5 lakhs. So you are recovering 9.8 lakhs rupees, and the entire amount you are crediting to P&L. You should not do that. You should only tax 2.3 lakhs now, because this 7.5 lakhs is already included in the sales earlier, and you have already paid tax. Therefore, you should only take what? 2.3 lakhs in the income, but you have unfortunately taken full 9.8 lakhs in the income. Therefore, reduce 7.5 lakhs from your PGBP income. Then you have to reduce what? 1 crore 18 lakh 50,000 rupees from your PGBP income, and then you have done some mistake once again. You have purchased some goods of 12 lakh rupees, which is not debited to the statement of P&L account in last year. Okay, so in the current year, you have purchased some goods of 12 lakh rupees, which is not debited to the P&L account. Okay, now you have purchased this goods from micro enterprise, and you have made a commitment that I will make the payment within 30 days. So again, I am saying 12 lakh goods you have purchased, not debited to P&L on 13th March from a micro enterprise, and you have made an agreement that I will make the payment within 30 days. Now you made the payment after 30 days check. From 13th March to 14th April, it is after 30 days. Now, because you have made the payment after 30 days, you will be getting the deduction on payment basis. Now, the payment is happening when? Payment is happening next year, 14th April 2025. Therefore, in the current year, the expenditure will not be allowed. This is not debited to P&L. Therefore, don't take the deduction. If this would have been debited to P&L, I would have added back. This is not debited to P&L, so don't reduce. If this would have been already debited, I would have added back. I hope it is clear to all of you. This is how you have to read the words. Now, one last thing. After that, you have to compute the total income and tax as per normal provision. Tax, I have already told you, 30%. Now, in 115BAA, what will happen? 4 items will be added back. First, donation given to political party will be added back in 115BAA. Then, scientific research donation will also be added back. Then, additional depreciation on imported machinery. At that time, it would be relevant. Okay, while computing the normal provision, don't take additional depreciation, because that is already included in 1 crore 18 lakh 50,000 rupees. Then, additional depreciation on local machinery, which you have borrowed from HDFC loan, that should also be disallowed over here. These 4 items you have to disallow. Once you do this, you will get what? You will get your total income as per 115BAA. Then on capital gains income, you have to apply 12.5% tax in excess of 12.5%. In I think so, it is 112A capital gains. Yes, 112A capital gains. So you have to take 12.5% tax in excess of 1.25 lakhs, and other income you will apply 22% tax, 10% surcharge, and 4% cess. I hope it is clear to all of you. Coming to the next question, which is on trust. That is a charitable trust which is registered under 12AB. What are they doing? There are 3 independent situations. We need to answer all 3 of them one by one. First charitable trust is registered as advancement of any other object of general public utility. Now, do you remember that? If you are a charitable trust which is registered as advancement of any other object of general public utility, then you can claim exemption only if your commercial receipt is up to 20% of total receipts. Now, in this case, the commercial receipt is 45 lakhs and the total receipts of the trust is 190 lakhs. Therefore, the commercial receipts divided by total receipts 45 lakhs divided by 190 lakhs is greater than 20%. Therefore, the trust will not be eligible for exemption. The trust will not be eligible for exemption in this case. I hope it is clear to all of you. So, what is commercial receipt? Commercial receipt means the fees which you charge to your customer. The amount which you charge to the customer deliberately for providing the service, that is called as commercial receipts. So that should be up to 20% of total receipts. So it is exceeding 20%, therefore you will not get exemption. Sir, will my registration also get cancelled? Registration will not cancel. Only registration, only exemption will be denied to your registration. You can continue. I hope it is clear to all of you. Second question. Good question, intelligent question. There is a charitable trust which is engaged in vocational training. They are providing some training. They have a training institute. They are providing some certificate courses for sewing machines, for handloom weaving, for handicraft. At the same time, this charitable trust also has a clothing shop at the entrance of the training institute. The shop derived 40 lakhs from sale of clothes, and whatever money they have derived, they are using for the purpose of training. They are maintaining separate books of accounts also for the separate books of accounts for the shop. So there are two things which the trust is doing. One, trust is providing training to the students. Another trust also has a shop from which they are selling clothes and they are earning money. Whatever money they are earning from selling the clothes, they are using for the purpose of training. They are maintaining separate books of accounts also. Can they claim exemption? The answer is yes. A charitable trust can have a business activity which is incidental to the business. A charitable activity which is incidental to the business is allowed, provided the money should be applied for charitable purpose and they should maintain separate books of accounts. So here, whatever money is coming from sale of cloth, they are applying for the purpose of what? Training institute, and they are maintaining separate books of account. Therefore, they are eligible for claiming exemption under section 11 and 12. I hope it is clear to all of you. Next question. There are two charitable trusts. One is engaged in clean drinking water. Another is engaged in water for all. Now, they want to get merged. Both of them are registered under 12AB. Now, they want to get merged and they have a question whether if they merge, whether exit tax will apply to them. Now, for that purpose, the government has brought a new section in Finance Act 2024 by the name 12AC. 12AC says that if you fulfill three conditions, we will not apply exit tax. Condition number one, both of them should be registered trust. One trust getting merged with another trust, both should be registered under 12AB or 1023C. Second, their object should be similar. Here the objects are similar. Drinking water, clean drinking water, water for all. It is a similar object. It is relating to water. So the object should be similar. And the third condition, they should fulfill some prescribed condition which the government has not yet prescribed. So as of now, only two conditions are there technically. Both of them should be registered trust under 12AB or 1023C and their object should be similar. If these two conditions are fulfilled, you can merge with another trust without worrying about what? Without worrying about the implications of exit tax. No exit tax implication will be applied on you. I hope it is clear to all of you. Next question, which is on TDS now. There are some independent situations in which TDS provisions will be asked. First, there are some amendments which are there, which I will tell you the amended answers. Some of the answers are not amended, but listen to my answer. Don't see the solution in this paper at least. Only this paper is of Jan 26, so therefore this is an old paper. The rest all are amended by me. Now, Mr. Rajesh is a lottery distributor. And Golden Lottery Agency is a very old lottery agency. It has a turnover of 98 lakh rupees in the last year. The last year turnover is 98 lakhs and they are giving Mr. Ramesh some commission of 18,000 rupees first and then 14,000 rupees later. Is Golden Lottery Agency liable to deduct TDS? The answer is yes. Under 194G, Golden Lottery Agency, which is a distributor, they will deduct TDS of the lottery agent. What is the threshold? The threshold is 20,000 rupees. The annual payment should exceed 20,000 rupees, then they should deduct TDS at the rate of 2%. Sir, the last year turnover is less than 1 crore, not relevant. Last year turnover is less than 1 crore or more than 1 crore. Those things are relevant for individual HUF under 194A, 194C, 194H, 194I, 194J, 194R, 194S, 206C subsection 1 and 206C subsection 1F. That is relevant in these 9 sections. That is not relevant in 194G. In 194G, they have just given us to confuse. In 194G, you are not supposed to see the last year turnover. I hope it is clear to all of you. Second question of TDS. Smart Switch Private Limited. It's a platform. It's a platform which is selling cryptocurrencies like CoinDCX, WazirX. Now, Mr. Adesh has purchased some cryptocurrency for 1 lakh rupees in 2024. November 24, and he has sold that cryptocurrency in December 24 at a profit of 347. Therefore, he has purchased for 1 lakh and sold at a profit of 347. Therefore, he has received 447. Selling price is 447. So, I am buyer, you are seller. I am buying something from you for 447. You are selling something to me at 447, but I am buying through exchange. You are also selling through exchange. Who will deduct TDS? The TDS will be deducted by the exchange. I will not deduct. The buyer will not deduct. The TDS will be deducted by exchange at the time of credit or payment, whichever is earlier, at the rate of 1% under 194S on the sale consideration. What is the sale consideration? The sale consideration is 447, not 347. 347 is profit. And the buyer is buying from Adesh. Adesh is selling, na? Buyer is buying. So the buyer is buying at 447, na? Adesh is selling at 447. Therefore, the cryptocurrency agency, that is the cryptocurrency platform, that is DCX, and in this case, Smart Switch Private Limited will deduct TDS at the rate of 1% on 447. I hope it is clear to all of you. Next question, question number 16, which is on assessment procedure. There is an assessing officer who has taken an approval from Principal Commissioner and directed that Greenfield Textile has to get their books of accounts audited under 142 2A. So he has given a direction for special audit under 142 2A. Okay. Now the commissioner has appointed the chartered accountant. Principal Commissioner has appointed the chartered accountant. Now the chartered accountant is not doing the audit on time. Deliberately he is delaying the audit. He is not doing the audit. Because of that, there is a delay in the audit, and therefore the assessing officer said that because the chartered accountant is not doing the audit, I will apply what? I will apply best judgment assessment on the assessee. Now the question over here, which came in front of Supreme Court in the case of Swadeshi Polytechs Limited, whether 144 can be imposed on the assessee if the chartered accountant is not doing the audit. There is no mistake of assessees. Assessee is completely cooperating. But the CA is not doing the audit for any frivolous reason. Frivolous means any hopeless reason. There is no reason. Can the assessing officer impose 144? The Supreme Court said that no. If there is a mistake, if there is a delay, if there is a non-compliance by chartered accountant, then the assessee cannot bear the burden of 144. The AO cannot impose 144 on the assessee. If assessee does not cooperate in audit, then the AO can impose 144. But if the CA is not cooperating, or if the CA is frivolous reason he is not doing the audit, or hopeless reason, unnecessary reason he is not doing the audit, you cannot impose 144 on the assessee. I hope it is clear to all of you. Next question. There is a partnership firm. Very simple question of penalty. The total income of the partnership firm is 40 lakh as per return. Then income processed at 42 lakh. Income assessed at 58 lakhs. It is not on account of misreporting. Therefore, you have to compute penalty at the rate of 50%. Now you are supposed to compute the penalty. How will you compute the penalty? Very simple. Income assessed at 58 lakhs minus income processed at 42 lakhs. 16 lakhs under reported income. Now you will compute tax on 58 lakhs first, then you will compute tax on 42 lakhs, then you will take the difference on, then that you will apply 50% penalty. Now they are asking one more question. Can we waive this penalty? Is there any way we can get immunity from imposition of penalty? If yes, what are the conditions? Yes, you have to fulfill 270AA. First of all, in 270AA, only 50% penalty can be waived. 200% penalty cannot be waived. In this case, the penalty is 50%. Therefore, it can be waived. If this would have been misreporting, 200% penalty, then 270AA would have not been applicable. So, what are the conditions that I have to supposed to fulfill? Listen the condition. Condition number 1. The first condition that I am supposed to fulfill is you have to make an application to the assessing officer within 1 month from the end of the month in which the order is received. Which order? Assessment order is received. Second condition, you have to pay the tax and interest within 30 days from the receipt of notice of demand. These 2 things you have to do. Third thing, you should not appeal against this order. Against this order, you should not appeal. Appeal is not possible against this assessment order. Then the assessing officer will pass the order. This is an amendment within 3 months from the end of the month in which the application is received. Earlier, this was 1 month. Then the assessing officer will pass an order. In order, he can say 2 things. 1, he is waiving your penalty. If he is waiving on penalty, great. If he is not waiving your penalty, then you can file an appeal against your original assessment order. So these are the things which are given in 270AA. Let's go ahead with the next one. Question number 18. There is a foreign company outside India which has a branch in India. Now there is a foreign company outside India or a non-resident outside India. They have a branch in India. They are allocating some head office expenses of 1 crore 85 lakhs in India. Will they get deduction in India? Yes. As per 44C, they can get. But how much? Amount allocated, that is 1 crore 85 lakhs or 5% of adjusted total income, whichever is lower. What if the adjusted total income is a loss? In this question, adjusted total income a loss. Adjusted total income is a loss in this case. Therefore, you have to take average adjusted total income of last 3 years. So if the adjusted total income is a loss, you have to take average adjusted total income of last year. Therefore, last 3 years adjusted total income is given. We need to find out the adjusted total income of last 3 years, and then we have to add all 3 of them, then divide by 3. That will be our average adjusted total income. Take 5% of average adjusted total income, compare with actual amount allocated, 1 crore 85 lakhs, whichever is lower will be allowed as deduction. Now, how to find out average adjusted total income? They have already given us total income, which is after all the items. Should I add depreciation? Do not add depreciation. We do not add depreciation to adjusted total income. Should I add addition? Should I add unabsorbed depreciation? Yes. UAD is added back. Should I add chapter 6? Yes. Chapter 6 is also added. You have to do this for all 3 years, and find out three adjusted total income. Then take average of all 3 of them, and then take 5%. Should I add brought forward short-term capital loss? Yes. Brought forward short-term capital loss should be added back. It is written in the law, brought forward losses. Should I add current year long-term capital loss? No, current year losses are not added back. Only brought forward losses are added back. Should I add brought forward speculative loss? Yes, add back that. Should I add VRS? Do not add VRS. This is already 1/5. If this would have not been 1/5, then we would have added back 4/5. This is already 1/5, so it is correct. If this would have been full amount, then we would have added back 4/5, because only 1/5 is allowed for VRS. Should I add back head office expense? Yes, head office expense definitely add back. After adding all these things, you will get 3 adjusted total income. Take total of all 3, divide by 3, multiply by 5%. Compare that with actual. Whichever is lower will be allowed. I hope it is clear to all of you. Next question is on safe harbor rule. Transfer pricing with safe harbor rule. High chances it can come in the examination. Be very careful. There are 3 transactions. We need to find out whether safe harbor will be applicable or not. First of all, we need to identify whether both the entities are associate enterprise or not. First of all, the services are provided by Tech Mitra Solution, an Indian company, and it is provided to Blue Orbit Solution, and both of them are associated because one entity holds 30% voting power in another. Therefore, both of them are deemed to be associate enterprise. This is the first thing. Second thing, we need to find out the nature of service. The nature of service is provision of software development services, which is nothing but provision of support services, which is nothing but software development services, and software development services is covered in safe harbor rule. Therefore, now we need to find out the transaction limit and the percentage. The transaction limit, if it is up to 100 crore, in this case it is 99 crore, you have to show a margin of 17%. Now let's see how much margin they are showing. How to find out margin? Operating profit upon operating cost. Operating profit is 8 crore, operating cost is 50 crore, therefore this is 16%. No, you have to show minimum margin of 17%, because your actual margin is only 16%. Safe harbor is not applicable in your case. Sorry, the doors of safe harbor are closed. Second transaction, this next era system Indian company, and this Neurocore Technology is a foreign subsidiary. Therefore, both of them are deemed to be associate enterprise. Now we will find out whether the service is covered in safe harbor or not. Provision of data processing services with the use of information technology. Yes, it is IT enabled services. Go and check the definition of IT enabled services. You will get that over here. Now here, if the transaction value is up to between 100 crore to 300 crore, more than 100 crore up to 300 crore, which is our case is 255 crore, 265 crore, sorry, the margin should be 18%. If it is 18% or more, we will accept safe harbor. If it is less than 18%, we will not accept. Minimum 18% you have to show. Now, what is the margin? The operating profit is 45 crore, operating cost is 225 crore, the margin is 20%, which is more than 18%. Therefore, the officer will accept safe harbor. I hope it is clear to all of you. Third one, there is a partnership firm, and there is another entity, there is another entity, Stratosphere Innovation, which holds 12% in the partnership firm. So if I am a partnership firm and somebody holds 10% or more, if I am a partnership firm and if somebody holds 10% or more in our company, then in our partnership firm, then we both are associate enterprise. Now, what is the service they are giving? They are giving provision of contract research and development services. Is it covered in safe harbor? Yes, it is covered in safe harbor. Now, if your transaction value is up to 300 crore, in this case it is 175 crore, you should show a margin of at least 25%. Now, what is the margin? 50 crore divided by 250 crore, the margin, actual margin is 20%, which is lower than safe harbor margin. Therefore, safe harbor is not applicable. Now, one last question which is asked over here. Will your answer change if the services are provided to an entity which is located in notified jurisdiction area? Yes. I have told you, and I have told you this is important also. When you provide services to a person which is located in NJA, safe harbor rule is not applicable. Safe harbor rule is not applicable in NJA. So if you provide all these 3 services to a person located in what? To all these 3 services, if you provide to a person which is located in NJA, then safe harbor rule is not applicable in all these 3 cases. What is NJ? NJ is notified jurisdictional area, which the CBDT may notify. Earlier they have notified Cyprus, then they have removed Cyprus. As of now, there is no country which is officially declared by Government of India as an NJ. But yes, in exam they can ask country X is an NJ, country Y is an NJ. Hypothetical question can be asked in the examination, which they have been asking again and again. Next question is a DTAA question. Ritika is aged 30 years, resident individual. She has a business in India and also abroad in country Z. We are supposed to compute total income of Ritika and tax of Ritika as per DTAA. India, as per 115 BSc subsection 1A, means as per new regime. India does not have DTAA with country Z. Let's compute the tax liability of Ritika here. What all things will come in Ritika's income? First of all, income from selling of phones, skins and covers, 12 crore 45 lakhs minus expense of 10.2 crore. This will be the net income. Similarly, income from country Z 15.5 lakhs minus 9 lakhs, the 6.5 lakhs income from country Z. Then commercial property rent 7 lakh 80,000, 65,000 into 12 minus 30% standard deduction, expenses not allowed. Then Ritika also has employed few employees. So she is eligible for 80 JJAA. 18 employees employed on 1st of May. Emolument is less than 25,000 rupees. Employees are employed for more than 240 days. Therefore, 80 JJAA eligible. 18 employees into 11 months into 23,300 into 30%. For these 22 employees also eligible because employees are employed for more than 240 days and emolument is also up to 25,000 eligible. Last not eligible because the employees are employed for less than 240 days. All of them participate in recognized provident fund. Yes, it is necessary. If you want to claim 80 JJAA, the employee should participate in recognized provident fund. Yes, the payment should also be made by online mode. After doing all these things, you will get total income of what? Ritika. After that, you compute tax. Now, the catch in this question is, in this question, there is coming marginal relief. Why? Because the total income of Ritika is coming to somewhere around 2 crore 7 lakhs. Now, if I compute tax on 2 crore rupees and surcharge on 2 crore rupees, then I compute tax on 2 crore 7 lakh rupees, the extra tax is coming more than the extra income. The extra tax is coming more than the extra tax is coming somewhere around 9 lakhs. The extra income is coming only 7 lakhs. Therefore, marginal relief you have to apply here. So the solution I have made over here, because this is old solution, only this question is old in the entire PDF. Only this question is old. Rest all solutions are updated. So for this solution also I have given updated solution here. So first you will compute tax on 2 crore and surcharge on 2 crore. What is tax on 2 crore and surcharge on 2 crore? Apply slab rates, then apply 15% surcharge. You will get 64 lakh 17,000. Then extra income is 745. Add extra income. Add extra income and then add cess on that, you will get your tax. And then you will find out the what? Then you will find out the double taxation relief. I hope it is clear to all of you. So marginal relief is the catch in this question. Otherwise, your answer will go wrong. Huh? You need to be very careful when you are close to the marginal relief income. I hope it is clear to all of you. So this is what this RTP is all about. I'll take a break for 2 minutes now. Then we will continue with last RTP. Now let's go ahead with one last RTP, that is RTP May 2026. After this, we will be completed with 9 RTP compilation exhaustively in full English along with our Hindi division also. Okay. So the very first question again over here is on total income. There is a domestic company. We need to compute the total income, etc. Let's see the last line, what exactly they want. They want us to compute total income, tax liability under regular provision. Ignore MAT. Then also they have asked us to compute the total income as per 115BAA also. The turnover of last year is 350 crore. Therefore, the tax in the current year will be how much? Will be 25% because the turnover is not exceeding 400 crore rupees. Now let's start with the solution as per normal provision first, and then we will compute the solution as per the provisions of 115BAA. The depreciation as per the books of accounts will be added back. Then employer contribution and employee contribution of March. Employer as well as employee contribution of March is paid in the month of July. Is it correct? No. Employer contribution you can pay up to the due date of filing of return, it is allowed. But employee contribution has to be paid up to 15th of the following month. So employer contribution is correct, but employee contribution is wrong. Therefore, employee contribution in this case will be disallowed. I hope it is clear to all of you. Then you are giving some contribution of 1.5 lakh to a scientific laboratory, scientific research association, etc. Therefore, that is allowed under section 35, but in 115BAA, it will be disallowed. Be very careful. In 115BAA, it is not allowed as a deduction. Next one, you are incurring some advertisement expenses of 55,000 rupees, which is paid by account pay check. Till here, it is good. But you are giving this advertisement in a political party brochure. Now, that is not allowed in PGBP over here. In PGBP, it will not be allowed, but under 80 GGB, you can claim as a deduction. Under normal regime in 115BAA, this will not be allowed as deduction. So again, I am saying advertisement in a brochure of a political party is not allowed as a PGBP expense. But under chapter 6A, you can claim as a 80 GGB deduction, but under 115BAA, you cannot claim. Next is a very routine adjustment again. Provision for gratuity based on actuary, that will be disallowed under 40A7, and whatever provision is paid, that will be allowed under PGBP. So 1.2 lakhs will be disallowed and 5 lakh will be disallowed. Next one, opening stock is overvalued by opening stock is overvalued. Now, if your opening stock is overvalued, it means you are claiming more expense. If you are claiming more expense, you have to add back. So you cannot claim more expense now. Opening stock is overvalued, but that means debit side of the P&L is overvalued. Debit side of the P&L is overvalued means you have claimed more expense, your profit is less, so increase the profit. Closing stock is overvalued. If closing stock is overvalued, it means your income is overvalued unnecessarily, so reduce. So the opening stock overvalued will be added back and the closing stock overvalued will be reduced. Then dividend from foreign company reduced from here, show under IFRS, very routine adjustment. Then profit on equity oriented fund on which STT is paid, so this will come under 112A. How much profit is there? 7 lakh profit is there. So reduce 7 lakh from here and show under what? Show under capital gains under 112A. It will be taxable at 12.5% in excess of 1.25 lakhs. Sir, what is the consideration of this? The consideration of this will be 11 lakhs. How, sir? See, the profit is 7 lakh and the units were acquired 2 years ago, before 2 years ago for 4 lakh rupees. Therefore, the full value of consideration is 11 lakh, cost of acquisition is 4 lakh, profit is 11 lakh. Again, I am saying the treatment, reduce 7 lakh from here and show 7 lakh under capital gains, 112A, because it is long-term capital gains, 12.5% tax in excess of 1.25 lakhs. Then there is some cash lost due to theft. So it's okay, it's a part of business, it's a revenue expenditure, you can claim that as a revenue loss and therefore it is allowed. Since it is already debited to P&L, you don't have to do anything, just write a note. Next, depreciation on tangible fixed asset, 8,50,000 you can claim as a deduction. Then you have purchased some power generating units on 1st of July for 25 lakhs. Now, you need to be very careful. The payment is made as follows. First, you made a payment, advance payment of 3 lakh rupees in cash, not allowed. It is written in section 43(1). If you make a payment for a fixed asset in excess of 10,000 rupees to a person in a day by other than 4 modes, then that expenditure shall not form part of actual cost. You are making the payment of 3 lakh rupees here in cash, therefore this will not form part of actual cost. So out of 25 lakhs, reduce this 3 lakhs. Then out of this 25 lakhs, 7 lakh is given as a government grant. So government grant should also be reduced from actual cost. As per explanation 10 to 43(1). Any amount which is made by any person should be reduced from actual cost as per explanation 10 to 43(1). Then the remaining payment is made by check through banking channel of 15 lakh rupees. Therefore, this will be part of actual cost. So therefore, eventually what will be the actual cost? 25 lakhs minus 3 lakhs minus 7 lakhs. Therefore, the actual cost is only 15 lakhs. On 15 lakhs, claim 15% normal depreciation, 20% additional depreciation because the asset is put to use for more than 180 days. But in 115BAA, you will not get the deduction of additional depreciation. That time you add back. Okay. Next one. The company paid cash in the current year for purchase of raw material of last year. So last year you purchased some raw material, you claim deduction on accrual basis, and in the current year you paid 85,000 cash. Therefore, this will be deemed income in the current year. So in the last year you claimed 85,000 as a deduction on accrual basis. Now in the current year you should make the payment by 4 modes, but you have not made the payment by 4 modes. You are making the payment by cash. Therefore, it will be deemed income in the current year. Next, you have purchased some raw material of 18 lakhs, but due to poor quality, you are making payment of only 14 lakhs. 4 lakh is remitted and seized by the creditor. So out of 18 lakh purchase, 14 lakh is payable, 4 lakh is remitted by the creditor. Therefore, 4 lakh will be deemed income under section 41(1). Remission or cessation of a trading liability is deemed income. Therefore, this 4 lakh you have to add to your income. Okay. I hope it is clear to all of you. Next, you are distributing dividend of 1.5 lakhs in the current year. Okay. How much dividend you are distributing? 1.5 lakhs on 15th of October. Late. You cannot claim ATM. To claim ATM, you should distribute dividend 1 month prior to the due date of filing of return. What is the due date of filing of return of this assessee? 31st October. Sir, why not 30th November? See, it is written in the question, the assessee has not entered into any international transaction. Therefore, 30th November is not possible. Only 31st October is possible. If 31st October is the due date, you should distribute the dividend by 30th September. You are distributing the dividend on 15th October. Therefore, provision of ATM will not be allowed. After that, you have to compute tax. Two tax will come, 112A. 12.5% in excess of 1.25 lakhs, and normal income will be taxed at 25% because the turnover of last year is below 400 crore. Now in 115 BAB, what will you do? In 115 BAA, sorry, 3 items will be added back. First, additional depreciation on this machinery will be added back. Then 80 GGB, that advertisement donation will be added back, and then scientific research donation will also be added back. 22% tax on special income, 12.5% in excess of 1.25 lakhs, then 10% surcharge and 4% cess, and then find out whichever is more beneficial. I hope it is clear to all of you. Next question is on charitable trust. There is a charitable trust. Point number 1. Sahitya Charitable Trust, main object is medical relief. Now they are earning some incomes. First income, they are earning income from tax-free bonds, 1,10,000, which is exempt under tax section 1015, and second is agriculture income, which is exempt under 10.1. So their question is, they are a charitable trust, can they claim both the exemption? The answer is no. I have told you this earlier also in earlier RTP, that if you are a charitable trust registered under 12AB, then you cannot claim any exemption under section 10 except 10.1. 10.1 you can claim. Therefore, in this case, you can claim 10.1, 10.15 you cannot claim. Therefore, in this case, the first one you cannot claim, the second one you can claim. I hope it is clear to all of you. The institute has already given, the first one is covered under 10.15, the second one is covered under 10.1. So they have also given the section number, so it's okay. If they would have not given section number, then there would have been some problem. We need to think about it where it is exempt. But anyways, anything apart from agriculture income is not eligible. You have to think like that. You don't have to remember each and every section. Next trust, Jyoti Vidya Jyoti Educational Trust, registered under 12AB. They own a building. So the trust own a building. Now they are giving this building on rent to a private coaching institute, which is owned by the wife of the founder of the trust. Now, the wife of the founder of the trust is considered to be specified person under section 13 subsection 3. Now, you cannot give unreasonable benefit to specified person. So, if you are giving that building on rent to the wife of the founder, it is okay. There is nothing wrong, but give at market value. If you give unreasonable benefit, then the trust will be gone. So, you are giving at a rent of 20,000 per month, whereas the market rent is 70,000 per month. Now, you are making a mistake. You should not give at 20,000, you should give at 70,000. So, what will happen to the trust? Multiple implication. First of all, 115 BBI will apply. Specified income, 30% tax. Then penalty will be applied 271 AE. If you pass unreasonable benefit to your specified person, first time the penalty will be 100% of the unreasonable benefit given. Second time it is 200%. Then whatever rent they are earning, how much rent they are earning? They are earning a rent of 20,000 rupees. This part of income is not eligible for exemption. On this 20,000 rupees, they will not get 15% exemption. They cannot apply and claim exemption also. So 3 implications you have to keep it in mind. Similarly, next trust is also doing something similar only. There is an Arogya Welfare Charitable Trust, which is providing free medical facilities to poor people. Now in this case, there is one person by the name called as Mr. Karan, who has contributed 75,000 rupees to the trust in the current year, and till last year he has contributed 9,50,000 rupees. So, is Mr. Karan a specified person? The answer is yes. There is an amendment in the definition of specified person, if you remember. Who is a specified person as per the amended definition as per Finance Act 2025? If a person is contributing more than 1 lakh rupees in a financial year, he is a specified person. No, Mr. Karan is only contributing 75,000. Therefore, because of this reason, he is not specified person. Second condition, if a person is contributing aggregate amount to the trust till the last day of the financial year of more than 10 lakhs. Is Karan contributing more than 10 lakhs? The answer is yes. Till last year, Karan has contributed 9.5 lakh. In the current year, Karan has contributed 75,000. Therefore, the aggregate contribution by Karan to the trust is 10 lakh 25,000. Therefore, because of this reason, Karan is a specified person. And now you cannot give unreasonable benefit to the Karan. Now you are doing unreasonable things for Karan. Check. First of all, you have to prove that Karan is a specified person, which I have proved because of this 10.25 lakhs. Now, are you giving unreasonable benefit to Karan? The answer is yes. You are selling some old furniture at 1,20,000 rupees, whereas the market value of the furniture is 2,80,000. So, you are giving unreasonable benefit to Karan of 1,60,000 rupees. You are selling at a cheaper rate, which is wrong. Again, 115 BBI will apply in the hands of the trust, and 271 AAE will apply in the hands of the trust. And this amount which is trust is receiving by sale of furniture, that cannot be subject to exemption under 11 and 12. I hope it is clear to all of you. Next question. Very good question. We have done that in class. It's a Delhi High Court judgment of UCO Bank. CBDT has also accepted this view of Delhi High Court. So it's a well established principle now. Suppose I have gone to court and there is some case going on me. Now the judge is saying that you have to deposit 10 lakh rupees till the time the case is not completed. So I give 10 lakh rupees as a security to the judge. Now, what will the judge do? The registrar of the court will deposit that money in the bank and will earn some interest. Now, the bank is paying some interest to the registrar of the court. Will bank deduct TDS under 194A of the registrar of court? The Delhi High Court in the case of UCO Bank has said that no. This is not our income. This is not the income of the court. We are just doing it on behalf of what? On behalf of the person who is fighting the case. So, therefore, whatever interest which is paid by banks to the registrar of the court will not be subject to TDS. Registrar of the court is not payee for the purpose of 194A. The payee is ultimately who? The person who will win the case. And who will win the case? That only time will say. Now I cannot say. Therefore, this amount which is paid as an interest by registrar of court to by bank to the registrar of court will not be subject to TDS. I hope it is clear to all of you. Next question has 4 transactions. You need to say whether TCS will apply or not. First transaction, the assessee is selling some timber under forest lease. So whether TCS is applicable? Yes. 2% TCS is applicable at the time of debit or receipt, whichever is earlier. See here, the assessee is Mrs. Green Resource Limited. It is engaged in extraction of foreign produce and minerals. It is selling some timber under forest lease to Mrs. Buildwell Infrastructure Private Limited. So on this transaction, 2% TCS will be applicable. Then there is some scrap which is sold by assessee to resident. Now, scrap is sold by assessee to resident. This will be subject to 1% TCS under 206C subsection 1. This is also covered in 206C subsection 1. This is also covered in 206C subsection 1. Third, the assessee is selling some coal to a resident and the buyer is giving a declaration that he will use this coal for generating power. He will use this coal for generating power. Therefore, you should not deduct. You should not collect TCS. So in the third case, the assessee is supplying coal, but the buyer is saying that I will use this for electricity purpose. I will not use this for trading purpose. So in that case, TCS is not applicable under 206C subsection 1A. Fourth one, you are giving toll plaza on lease. So if you give on toll plaza on lease or parking lot on lease or mines on lease or quarry on lease, you should collect TCS under 206C subsection 1C. But if you give this to public sector undertaking, then TCS is not applicable. Go and check. Such minute things they are asking. If you give this to public sector undertaking, then TCS is not applicable. I hope it is clear to all of you. Next question is on provisional attachment. Let's try to understand what is this question all about. First of all, the regular assessment for AY 23-23 of the assessee, 23-24 of the assessee was completed on 16th of July 2025. Okay, regular assessment completed. Then income escaping assessment notice has come on 18th of January 2026. During the income escaping assessment, the AO wants to attach the house property of Miss Preeti. So the AO wants to do provisional attachment provision under section 281B. Now we need to answer 3 questions. First, the circumstances under which the AO can make provisional attachment of the property. So 281B says that if there is a pendency of assessment and if the officer has taken approval from Principal Director General, Principal Chief Commissioner, etc., and it is in the interest of the revenue to protect the revenue of the government, then they can do provisional attachment under 281B. So 3 conditions has to be fulfilled. First of all, there has to be a pendency of assessment. Secondly, they have to take approval from higher authority, and then they should have a opinion that it is in the interest of the revenue. Second, what is the time period for which such attachment can be made? They can provisionally attach your property for a period of 6 months from the date of order. Can that be extended? Yes. The officer has to record the reasons in writing. They have to record the reasons in writing. Then it can be extended for a period of 2 years or 60 days from the end of the completion of assessment, whichever is later. So it can be extended for 2 years, or if the assessment is completing later, then 60 days from the completion of assessment, whichever is later. Can such attachment be, provisional attachment be revoked by AO once he has attached? Now, can he revoke that? Can he leave that property? Yes, he can leave. in writing, he will revoke in writing, provided the assessee has to fulfill some condition. First, assessee has to give a bank guarantee. Second, the bank guarantee should be given from a scheduled bank. Third, the bank guarantee should be equivalent to the FMV of the asset. If these conditions are fulfilled, the AO will revoke the provision attachment order, and the property will be given back to you. Next question we have already done. You can check it earlier. I'll just give you the synopsis also if you don't remember. We have done in earlier RTP. There is a foreign company which has become resident in India due to poem. So now the foreign company has become resident in India due to poem. Now that foreign company is also, that foreign company is resident also. Now we are making some payment of professional fees. So should I deduct TDS under 194J or 195? So the law says that you have to deduct TDS under 195 and not under 194J. So that is what this question is all about. So we have done this similar question earlier, same to same question we have done earlier. Now the next question is a very good question on business trust. Mr. Ricardo, who is a non-resident, is holding 10% units of the business trust, and the business trust has distributed the following income to Mr. Ricardo. Always remember now, in this question, this is not the income of the trust, this is the income of Mr. Ricardo directly. They have directly given us 10% income of Mr. Ricardo, so don't do again 10% of this. Your answers will go wrong. Okay, so they have directly given. See, they have given information that Mr. non-resident holds 10%, and they have given that these amounts are given to non-resident only. So these are not the total income of the trust. These are the distributed income which is given to Mr. Ricardo. I hope it is clear to all of you. Now we need to answer the following things. One more information is given that Grey Limited does not exercise. Who is Grey Limited? Grey Limited is SPV. SPV does not exercise the option under 115BAA. That is very important for taxing dividend income. First of all, let's try to understand one by one. Rental income from real estate property. What will happen? Rental income from real estate property is exempt in the hands of trust. Business trust taxable in the hands of investor under 194 LBA. The investor, the company will deduct TDS. The trust will deduct TDS. So if a business trust invests in land and building, earns rental, exempt in the hands of business trust, taxable in the hands of investor. Investor is non-resident, therefore deduct TDS under 194 LBA at rates in force. Rates in force is the highest rate applicable to the Mr. Ricardo, that is 30% tax plus 4% cess. Interest income from SPV, again exempt in the hands of business trust, taxable in the hands of investor. Because investor is non-resident, you should deduct TDS at 5.2%. 5% tax, 4% cess. Dividend income. What is the treatment of dividend income? Dividend income exempt in the hands of business trust, always. In the hands of investor also exempt. Why? Because the company, the SPV is not following 115BAA. If SPV is not following 115BAA, the dividend is exempt in the hands of the investor. But if SPV is following 115BAA, it is given in the last line. Assume that SPV follows 115BAA, then what will happen? Then it will be taxable. And you have to deduct TDS at the rate of 10%. I hope it is clear to all of you, plus cess. Last but not least, apart from rental income, interest income and dividend income, the business trust is also distributing 2 crore rupees to all the unit holders. It means to Mr. Ricardo, they will distribute 20 lakhs to all unit holders. See, somewhere they are writing only Mr. Ricardo's share. Somewhere they are writing to all unit holders. You need to be very careful with the wordings in the question. So the above information is for only Ricardo. The below information, 2 crore is for all. So Mr. Ricardo is getting 20 lakh rupees over and above these 3 items. That is nothing but debt repayment. So there 56(2)(12) will apply. What is 56(2)(12)? Any amount which is given over and above rent, dividend, interest, etc., that will be taxable as IFOS in the hands of the investor. How much IFOS? Whatever is given as debt repayment minus whatever is the price of the units purchased in business trust. What is the price of the unit purchased in business trust? 15 lakhs. And what is the amount given over and above all these items? Over and above all these items, 20 lakhs. And the unit business trust units cost is how much? 15 lakhs. 5 lakhs rupees will be taxable as income from other source in the hands of Mr. Ricardo. No TDS is applicable on that provision. So the government has not put any TDS on that particular part of the income. No TDS provision is applicable on that income. I hope it is clear to all of you. Now the next question is very good question. Just one change I have to make. I have to write down here. What I have to write down here? 6.4 crore. That is not 7.2 crore. That is 6.4 crore. Now, to explain this entire question, I have put this example. Try to understand this example first of all. Trex Inc. Trex Limited is an Indian company. They have taken some loan from Mrs. Refine Inc. last year 90 crore. But last year they have repaid 10 crore. Therefore, effectively the loan is only 80 crore. Okay. Now they are paying interest on 80 crore, 6.4 crore, 8%. Trex, Messrs. Refine INC is what? Is a third party. Messrs. Refine INC no, is not our associate enterprise. So we are paying 6.4 crore interest at the rate of 8% on 80 crore, 10 crore is repaid. Therefore, this 6.4 crore interest we are paying to third party. Now there is one company, Prestige INC, which is giving guarantee to our associate enterprise. Now there is one more company, Bright INC, which is holding 40% in Trex and 40% in Prestige. Therefore, because Bright INC holds 40% in Trex, 40% in Prestige, therefore Trex and Prestige are associate entity. Therefore, Trex and Prestige are associate entity, and our associate entity is giving guarantee to third party. Therefore, this interest will be coming under limitation of interest. As simple as that. So again, I am saying, Prestige is now eventually our what? Prestige is eventually our associate enterprise. Prestige is our associate enterprise. Why? Because Bright holds 40% in us, 40% in Prestige. Therefore, we and Prestige are associated. An associate entity gives guarantee to Messrs. Refine INC. Therefore, the interest paid to Refine INC will be coming under limitation of interest under 94B. Now, the question is that there is some disallowance of last year also. Last year also some disallowance is there of 7.5 crore under 94B. How much we can claim in the current year as a deduction? We can claim up to 30% of EBITDA. For that, we need to find out EBITDA. EBITDA is how much? 18 crore is your net profit. Add interest in that 6.4 crore. Add 4 crore depreciation and add 2.7 crore tax. 31.1 crore is your EBITDA. Up to 30% will be allowed in the current year. What is 30% of EBITDA? In excess of 30% is disallowed as per 94B. It means up to 30% is allowed. Therefore, 30% will be allowed in the current year. Therefore, 9.33 crore will be allowed in the current year. Now, 9.33 crore interest you can claim in the current year, out of which 6.4 crore is current year interest. Therefore, remaining 2.93 crore you can claim for last year. So, out of 7.5 crore, you can claim 2.93 crore in the current year, and balance out of 7.5 crore you can carry forward for the next years. I hope it is clear to all of you. It's a good question. We have done a similar question earlier also. And one last question over here, which is on DTAA. Shrestha, resident individual, 34 years. She is earning some income from the various country. India does not have DTAA with foreign country. She has not opted out of default regime. See, they are playing with language, English. Is this a tax paper or English paper? I don't understand. She is not opted out of default regime means she is following default regime. It means she is following new regime. They could have easily said she is following default regime. No, but she is not opted out of default regime. It means she is not going out of default. It means she is remaining in default. It means she is following new regime. What the hell is this? Is this an English paper or a grammar paper or a tax paper? I don't understand. Anyways, whatever is there, we have to take care of it. Now let's try to compute the income. First of all, she is earning income from business from Jaipur. On that, she is incurring expense of 3.5 lakhs. So the net income is 26 lakhs minus 3.5 lakhs. Then she is earning rent from country M, 95,000 rupees per month minus 30% standard deduction you will take. Expenses will not be allowed in India. Only 30% standard deduction allowed. Then she is earning agriculture operation income of 18 lakhs. On that, she is incurring expense of 8.5 lakhs. So 9.5 lakhs will be taxable. Then she is earning dividend income from country M, IFOS. Now, agriculture income is exempt in country M. So this is not doubly taxed. This will not be doubly taxed because this is exempt in country M and only taxable in India. Okay. So we have to compute total income. So total income will include what? 26 lakhs minus 3.5 lakhs. Then 95,000 minus 30%. Then 18 lakhs minus 8.5 lakhs. And then 4,20,000. Then you have to compute tax. After you have computed tax, now you need to find out doubly tax income. Now the most important catch over here is doubly tax income. Which incomes are doubly taxed? Is this first income doubly taxed? No, because this is Indian income. This is not doubly taxed. Is this second income doubly taxed? Yes, this is doubly taxed. Is this agriculture income doubly taxed? No, because agriculture income is not taxable in country M, so you cannot say it is doubly taxed. Is this dividend income doubly taxed? Yes, dividend income is also doubly taxed. So two incomes are doubly taxed. I am highlighting with different colors. So this dividend income is doubly taxed and this rent income is doubly taxed. Now, dividend income is doubly taxed how much? 4,20,000. And the rate is how much? 20%. Compare with average rate in India, whichever is lower will be allowed as relief. But, there is a catch in rent doubly tax income. Rent is doubly taxed in India. In India, rent is taxed at 7,98,000 because 95,000 into 12 minus 30% comes to 798. But in country M, the rent is taxable at 6,15,000 only. Why? Because in country M, the rent is taxable at 95,000 into 12 minus 5,25,000. Because in country M, all these expenses are allowed. Therefore, what is doubly taxed in India? In India, rent is taxable at 798. Because the deduction is allowed different. In India, it is 30%. In country M, it is 5,25,000. Therefore, in India, the income tax is 7,98,000. In foreign country, the income tax is 6,15,000. Therefore, doubly tax is how much? Doubly tax is only 615. You cannot say 798 is doubly tax. Therefore, on 615, you have to apply whichever is lower rate. I hope it is clear to all of you. And on dividend income, you have to apply on 4.2 lakhs because dividend income is same in both the countries. I hope it is clear to all of you. So this is what this RTP is all about. So here we complete 9 RTPs exhaustively in full English. The next target after this will be to complete 9 past paper, including the Jan 2026 paper, for your reference exhaustively in the same manner and probably in a better manner if it is possible from my side. I request all of you to do only few things. First, watch this video again and again. Again and again, you try to watch this video as many times as possible. This is the most important video for you. Second thing, you have to make sure that if you want to learn all these things in great detail, I am doing just revision. If you want to learn all these things in great detail, we have covered all these things in great detail in our regular batch, in our exam-oriented batch, and also in our practical question batch. In this compilation video, we are going to cover around 200-250 videos. But in our regular batch, exam-oriented and practical question batch, we have covered more than 550 questions. More than 550 practical questions. And there I have explained each and every point in detail. Here the objective is from the exam day perspective. How will you revise on the day of examination? But if you want to do it in detail, you can enroll for our respective batches in full English, which is available on our website. You can check it over here. Third thing, the PDF of this I have already uploaded on our Telegram channel. You can download the PDF from there. Okay.